Welcome to the audiobook, The Trader's Book of Volume by Mark Leibovit. In this classic trading guide, Mark Leibovit explains the critical role of volume in analyzing the markets. By understanding how volume works, traders gain an edge in spotting trends, reversals, and opportunities others may miss. Here's a quick outline of the first 7 chapters. Chapter 1. The Role of Volume. Why volume is the most important yet often overlooked indicator in trading. Chapter 2. History of Volume Analysis. A look back at the evolution of volume studies and key contributors. Chapter 3. Principles of Volume. Interpretation. Core rules and patterns that guide volume analysis. Chapter 4. Tools and Indicators. An introduction to the main technical tools that incorporate volume. Chapter 5. Practical Applications. How traders can apply volume analysis in real-world markets. Chapter 6. Case Studies. Real examples showing how volume reveals market direction. Chapter 7. Common Mistakes. Pitfalls traders must avoid when relying on volume. Stay tuned as we dive into these chapters and uncover how mastering volume can sharpen your trading edge.
The Trader's Book of Volume, The Definitive Guide to Volume Trading by Mark Leibovit. Introduction. In April 2010, my proverbial ducks were lined up. I called the sharp stock market reversal, which started with the painful flash crash of May 6, 2010, and ended up in the worst May stock market performance in 70 years. I've also called many other serious market reversals, as I'll describe shortly. These downturns may have been precipitated by the events and news headlines of the time, but they were also foretold by observable indications of vulnerability before the crises struck. How was I able to accomplish this? What's so special about the methodology I employ? How is it different from all the other trading strategies out there, all those crystal balls that work until they don't? In a word, my methodology is based on a key component that few comprehend or have taken the time to truly examine. My methodology, upon which the Trader's Book of Volume is based, reflects my more than 30 years in the financial industry, exploring and analyzing how volume affects the markets. The volume and price relationship. The stock market adage that volume precedes price is really more than just an adage or a memorable saying. It is my contention that volume is a determining factor in market strength and trend direction. As I have stated so often in my seminars, and as you will read in depth in this book, without a proper volume analysis, you are essentially trading in the land of the blind. Using volume indicators and oscillators in my own work, I rely heavily on my proprietary Leibovit volume reversal trademark indicator. A trader can generate indisputable signals concerning the future direction of the markets. In my career, I have never been caught in a stock market crash. I'm on record as having called the 1987 crash on Louis Rukeyser's Wall Street Week on PBS. I also called the bear market in February 2000 at the height of the internet bubble and the decline ahead of the horrific attacks on September 11, 2001. Most recently, I provided my clients with a sell signal weeks ahead of the flash crash of May 6, 2010, calling the shots. So how did I come to anticipate this latest broad market trend reversal? A good place to start was with the shot across the bow fired on April 16, 2010, when the Securities and Exchange Commission charged Goldman Sachs and Company and one of its vice presidents with fraud tied to a subprime mortgage financial product. Nearly 8.1 billion shares traded to the downside that day, generating a technical sell signal in the Leibovit volume reversal indicator. There are many factors I consider in my volume analysis. The sharp increase in volume signaling a sudden shift in the marketplace from buyers to sellers on that date was one of them. Several other pieces of dramatic news rocked the markets over the next few days. The first was on April 27, 2010, when the stock market sold off on heavy volume amid increased speculation that Greece would be forced to restructure its debt. The second occurred amid growing rumors that Chinese regulators might try to slow their country's robust economy. Regardless of the news or the trading events around it, I rely on volume analysis for my timing signals. In my volume methodology, a second negative Leibovit volume reversal raised a red warning flag that market internals were deteriorating. In charts 1.1 and 1.2, A trader using volume analysis would be able to spot the negative divergences warning that something is rotten in the state of Denmark. Chart 1.1 reveals that despite rising prices in the Standard & Poor's 500 index, S&P 500, during March and April, the money flow index was declining, and the volume price trend was not in sync with price. In chapters 8 through 10 of the Trader's Book of Volume, we will be looking in depth at these and other volume-based indicators and oscillators, and how they're used in volume analysis. In Chart 1.2, the Leibovit volume reversal indicator generated numerous negative volume reversal patterns in the weeks prior to the flash crash. It clearly demonstrated that smart money was exiting the market and provided footprints of a shift in trend direction, in this case, lower in the markets. As a result of volume analysis and my volume tactical overlays, see Chapter 11. We flashed a sell signal to our financial newsletter subscribers at VRTraderCom in the weeks and days prior to the event. In effect, a trader using volume analysis would not have viewed the events of May 6, 2010, and the market's 1,000-point decline as a random event. Rather, it should have been technically anticipated. This market call comes on the heels of numerous other such calls I've made in recent years, all coming as a result of a sudden shift from buyers to sellers. For instance, before the attacks on the World Trade Center on September 11, 2001, 9/11, the broad market was setting up for a reversal. In Chart 1.3, note the sequence of negative volume reversals in the weeks prior to the attack, which in my approach was a clear sign of market distribution, or selling. There was no way of predicting the tragedy of 9/11 or the market crash that was around the corner, but volume clearly signaled traders to step aside, sell, and take profits or even to go short. In Chart 1.4, the Nasdaq 100 Index, NDX, and Chart 1.5, the Exchange Traded Fund ETF equivalent QQQQ. It was abundantly clear that during 2007 a market top was forming by virtue of negative divergences, i.e., rising price and declining volume, warning of potential trouble. In addition, my Leibovit volume kicked in during the fall of 2007 with negative volume reversals, or VRs, Chart 1.4, as sellers were getting more and more aggressive. The end result, of course, was the huge decline during the fall of 2008 and into March 2009. The pattern was even clearer when observing the divergence between price-volume price trend and money flow index in the Nasdaq Power Shares ETF, QQQQ. Many recall the brief 1998 market panic caused by Russia's debt crisis. And for those who don't, Sergei Ulatov offers a great summary in the Brookings Papers on economic activity. On August 17, 1998, about a little more than a month after an international package of emergency financing and economic reforms was announced, Russia was forced to devalue the ruble. Russia also declared its intention to restructure all official domestic currency debt obligations falling due to the end of 1999. Looking at the volume reversals in the E-mini S&P 500 futures contract, see Chart 1.6. The signs were there in the market prior to both stages of the decline. It's worth taking another look at the top in March 2000, which led to a 2-year bear market. The exact day of the top for the Nasdaq was March 10, 2000, and as can be seen in Chart 1.7, sellers were active all through the spring and summer of 2000. Volume was again telling us that trouble was on the horizon. Specifically, the volume on the upswings was weak, indicating that traders, especially large buy-side traders, were running out of gas. Many of you may not have been in the market during 1987 or experienced the hair-raising crash on Monday, October 19, of that year, but volume analysis warned that there were problems ahead, and the crash was truly no surprise. Using IBM as a surrogate for the Dow Jones Industrials, note in Chart 1.8 the heavy distribution negative volume reversals beginning in mid-August 1987. As in all the previous examples, the charts were warning of problems ahead, enough so that you should have been looking to exit long positions or consider playing the short side. As we have often experienced, selling can lead to panics, and if volume is telling us that smart money is getting out of the market, aren't we best advised to head for higher ground? A picture is worth 1,000 words. Truth be told, I can't really look at a price chart and tell you what's happening without viewing an accompanying volume chart. Volume is what really tells me how much conviction or strength there is behind a move. There are many analogies for this, and I explore some of them in Chapter 1. In short, volume tells me the strength or the weakness behind a price move. It gives me a more complete view, a more dependable, reliable, and consistent picture of market trends. As traders, we know that when price rises or falls on increasing volume, there is strength and validity to the trend. When price rises or falls on diminishing volume, it's a sign that the trend is tired, buyers and sellers are tired, and the trend is vulnerable to a reversal. In the Trader's Book of Volume, we take these basic concepts further, examining in depth factors affecting volume and exploring how to ultimately translate the information that volume provides into trading profits. Volume technical analysis. If it were only so simple, we'd all be traders right off the bat. The truth is, while many volume signals are clear and strong, most are far more subtle and require translation. Putting your preconceived notions of trading aside, I contend that it is the combination of volume and price, the relationship, the patterns, the divergences, the strengths and weaknesses that really form the basis for volume analysis. But that said, I'll stand clearly in the camp that with volume and price together, it's a 1 + 1 = 3 story. That is, price and volume taken together tell far more to a trader about market trends, reversals, and tactical timing than either can separately. The Leibovit volume reversal. Here's headline news from my VR Trader COM Platinum newsletter, June 4, 2010. The stock market is getting hit after declines in Europe and following a smaller than expected increase in payrolls. The Dow is down 212, S&P down 22, and Nasdaq down 41. VR Trader did it again. We bought inverse ETFs yesterday, and this morning we took profits. That's the third time in a row we profitably bet on a falling market. Indeed, I've been making such calls for years based on the Leibovit volume reversal indicator. In fact, a Leibovit YR was the basis for my call of most of the major market turns and crashes outlined in the beginning of this introduction. The Leibovit volume reversal indicator has been remarkably accurate in its ability to produce high-performance trades in both stocks and indexes based on the combined behaviors of price and volume. Because disclosing the details of the formula might compromise its effectiveness, I can't share too much of what happens inside this black box. But suffice it to say that it has been a remarkably successful trading system and application of volume technical analysis. I cover the volume reversal in greater detail in Chapter 9. Why a Trader's Book of Volume? As I mentioned earlier, there seems to be a plethora of books on trading, but there are few that pursue volume-based technical analysis in depth. The Trader's Book of Volume provides a comprehensive treatment that will allow traders to gain access to volume analysis-centric tools and methods, and to develop their own tactical volume overlay strategies. The Trader's Book of Volume focuses exclusively on volume analysis, of patterns and trends based on the volume-price relationship. It doesn't advance a methodology or trading strategy, but rather is constructed to provide a trader's eye toward exploring and using volume-based technical indicators and oscillators as a component in trading strategy. A brief word about tools. It's worth taking a minute to describe the charting and software tools that I use, and that were used to develop the 300-plus examples illustrating the indicators and oscillators presented in this book. One of my favorites is MetaStock, which is a proprietary computer program created by Equis International and is used for charting and technical analysis of stock prices. It has both real-time and end-of-day versions. The newest version, MetaStock 2, is 27 years in the making. The website is www.equis.com/. MetaStock enables you to scan a database of thousands of securities looking for prime trading opportunities. Among the 200 built-in indicators for individual stocks and 80 built-in indicators for broad market analysis are most of the volume indicators and oscillators discussed in this book. Metastock also provides a subscription-based add-on for traders using my volume reversal indicators for the equity and commodities markets in the United States, Canada, and abroad. In addition, many other charting and trading packages contain volume-based indicators and oscillators. About my newsletters. My technical expertise lies in volume analysis, and that subfield of technical analysis is what the Trader's Book of Volume is all about. Beyond this book, and preceding it, I have applied my technical experience and expertise toward the publication of 4 newsletters to provide short-term, high-performance stock trades and market timing based upon the Leibovit volume reversal indicators and trading strategy. By tracking positive and negative volume reversal signals, I have been able to call market moves and to flash buy or sell signals, and profitably exploit the momentum and volatility of short and midterm moves in stocks, indexes, and commodities with clearly defined risk management guidelines. Currently, I publish 4 newsletters. VR Platinum is targeted to high-performance traders, offers specific recommendations, entry points, targets, and stops for individual stocks and stock indexes and ETFs, and provides subscribers with a daily list of all monitored positive and negative volume reversals. VR Platinum is published pre-market, post-market, and on an as-needed basis intraday. The pre-market update provides an action alert section for the stock market, the Dow Transportation Average, gold and metals, bonds, crude oil, and the US dollar. VR Silver offers some of the VR Platinum material, but in a pre-market and post-market edition only, and is targeted to less active traders, as no specific recommendations are made. VR Forecaster is an annual forecast published between mid-January and early February, and contains my cyclical forecast for the major markets for the year. VR Gold Letter is a weekly newsletter that provides traders, portfolio managers, and investors with unique insights, opinions, and recommendations for the gold, silver, and platinum markets, utilizing the Leibovit volume reversal and cyclical annual forecast model strategies. These newsletters are based on and will expand your knowledge of volume analysis-based trading. You can find out more about the newsletters at www.vrtrader.com and about our consulting group at www.vrstrategic.com. Roadmap. The Trader's Book of Volume, Part 1, explores the concepts of volume technical analysis from a trading perspective. Chapter 1, Volume Basics, A Trader's View, discusses the importance of volume analysis in analyzing market behavior. In Chapter 2, The Trader's Mantra, Volume Precedes Price. Volume analysis is shown to provide traders with a multidimensional view of the trading terrain and greater depth and understanding of the volume-price relationship. Chapter 3, Navigating the Volume Trading Terrain, describes the 6 basic volume-price relationships of which every trader should be aware. Chapter 4, Spotting Volume Price Patterns and Market Trends, uses volume analysis and various volume overlay tools to explain market trends. In Chapter 5, The Volume Alert, Identifying Trend Reversal Patterns, the focus shifts to identifying volume patterns that signal a potential for a trend reversal. Chapter 6, News, Noise, and Volume, examines some of the factors and dynamics that affect volume patterns, such as daily market internals, seasonality, earnings announcements, and internal and external news events. Chapter 7, Trading Time Frames and Indicator Selection, explains the ways to understand and select the right indicators, oscillators, and time frames to fit the market condition, the securities being traded, and your own trading style. There's no one-size-fits-all solution. Part 2 is a compilation of volume-based indicators and oscillators with trading examples, and offers guidance on developing tactical volume overlays. Chapter 8, Broad Market Volume Indicators, covers 13 major volume indicators and oscillators that are used to assess trend direction, trend strength, and reversals across the broader markets. Chapter 9, The Volume Indicators, comprises a description and detailed examples of 10 new volume indicators and their behavior under a variety of trading conditions. Chapter 10, The Volume Oscillators, describes and gives detailed examples of 10 volume oscillators and their behavior under a variety of trading conditions. Chapter 11, Developing Tactical Volume Overlays, serves as a guide for traders in developing tactical volume overlays for trend identification, short-term trading opportunities, and sector and broad market timing. The conclusion, Keeping a Trader's Eye on Volume, delivers parting comments on the volume trading terrain. One ongoing frustration of mine has been that volume analysis has never been presented in a comprehensive format. In this book, I try to include the most widely available volume indicators and oscillators that were developed by the many very talented and creative market technicians who preceded me. As we all know, we stand on the shoulders of giants. Throughout this book, I express opinions based on my 30-plus years of market experience studying volume. The Trader's Book of Volume should help fill a void and hopefully inspire you, while generating some creative discourse surrounding the volume-price-trend relationship. Part 1. The Importance of Volume in Technical Analysis and How Basic Volume Analysis Works. Chapter 1. Volume Basics, A Trader's View. Is it volume which causes price changes, or do price changes cause volume, the hen or the egg which came first? H.M. Gartley, Profits in the Stock Market. Back in 1934, R.W. Schabacker commented in Stock Market Profits, his 300-page treatise on trading. In our entire study of Plate V, we have given no consideration to the factor of volume of trading, though this is another highly important and valuable angle of the technical approach to short swing trading. Having recognized the value of volume, he spent only 3 paragraphs discussing this highly important and valuable tool. Why was so little consideration given to volume? One explanation is that the data required for volume analysis were largely unavailable at the time and reserved only for the eyes of an elite group of market participants, an insiders club comprising floor traders, market makers, and institutions. Today, with the development of sophisticated desktop trading interfaces, along with more readily available market data, traders can access information that was previously in the exclusive realm of insiders. This more accessible data flow has opened the door into the realm of volume analysis and the strategic deployment of volume-based indicators, oscillators, and overlays to enhance trading performance. In this chapter, we challenge you to rethink any preconceived notions of price and volume as they relate to your trading strategy and offer you a short primer on the basics of volume. The case for volume. Volume analysis provides a trader with a clear and focused view of the collective behavior of financial market participants. Overwhelmingly, we traders have been indoctrinated with price-based indicators, but what if what is lying under the hood staring us in the face has eluded us? What if, at the end of the day, the behavior revealed by volume is the high-octane fuel that creates, accelerates, or decelerates market conditions? We've been told that market trends are created by market participants agreeing in aggregate that a fair price for a stock or commodity can be found, and that price moves accordingly to higher or lower levels. In volume analysis, we view the development of market trends as a dynamic process that cannot simply be explained based upon price movement alone. Our standard for identifying and predicting trend changes incorporates the volume action accompanying these price movements. Throughout our exploration of volume, our guiding principle will remain arguably simple. Volume action is linked to price movement. Most traders have a minimal understanding that a price move accompanied by strong or heavy volume is likely to continue in its current direction, and conversely, if volume is lighter than normal, the trend may be suspect. These concepts are about as in-depth an understanding as most traders will ever develop about volume. So, what of the behavior of volume in technical chart patterns, in trend continuation and reversals, and in volume overlays? It is our belief that volume is an essential component of every price move and pattern. If a trader is unable to read or translate volume information, if his understanding of it remains limited, then he is forced into the trading strategies and routine guidance more commonly serving the interests of the institutional crowd. By taking our trading off-road and examining the complexities of volume, we are taking a detour from trading based on price-driven data alone. It is our hope that as you explore the pages of this book on volume, you will gain predictive insight into trend direction and reversals, and ultimately develop your own set of defensive tactical strategies. A dynamic volume analogy. There are many analogies to describe the dynamic effects of volume on price trends. Most commonly, it is compared to fuel in a car engine. If the tank is low on gas, i.e., weak volume, the car engine eventually will falter and stall. Had the tank been full, i.e., strong volume, the car would have just cruised on down the road. Just as too much fuel can flood an engine, too much volume in the form of spikes and surges indicates an emotionally charged trading environment can signal that the engine might stop heading in its current direction, i.e., a change in trend is near. Remember, volume action is inextricably linked to price trend movement. In the Trader's Book of Volume, our focus will be to translate the meaning of volume information into trading strategies and ultimately into tactical volume overlays. How to begin to do this is to understand some volume basics. The coordinates we are measuring will act as our guide. We begin by understanding what information is embedded within and represented by volume. Volume as a measure of supply and demand. On any given day, both volume and price in the markets are constantly readjusting to accurately reflect the current market environment. If there is an imbalance of buyers in the market, price may adjust to higher levels to entice existing holders to sell their positions to offset demand or buying pressure. If there is an imbalance of sellers, price may adjust to lower levels to entice new buying to offset supply or selling pressure. As more traders line up and execute their intentions on either the buy side or the sell side, the increased activity shows up in the form of volume. How volume interacts with price on any trading day reveals the level of supply and demand in the market for that security or commodity. The behavior of volume during the trading day represents hard evidence that the imbalance between buyers and sellers is being resolved. Ultimately, it is the volume action, not the price action, as most of us have been taught, that signals the first indication of the direction of that resolution. Volume as a gauge of trader sentiment and interest. When we look at a fuel gauge, we get a sense of our ability to go the distance. Similarly, we can take a volume measurement to represent how much bullish or bearish sentiment there is in trading a particular market, index, or issue. Elevated interest in the form of higher than normal volume gives clarity as to when and at what level the next potential price move may occur. Normal volume will depend on our trading time frame and the unique volume characteristics of the index or issue being traded. But once normal is determined, any departure from that is significant. A case in point, using a volume moving average, a trader can identify higher than normal volume with small price swings, which may indicate that shares are being either accumulated or distributed in a sideways market. Below normal volume on larger price swings, especially in trending markets, may signal to a trader that a shift in trend is imminent. Volume analysis thus serves to improve a trader's predictive ability as to the timing and direction of trends and reversals, using volume to track the major market players. A major strength of volume analysis is its ability to track the trading activity of the largest market participants, that is, mutual funds, large hedge funds, and institutional players. These elite players often intentionally camouflage their positions. By using volume analysis, a trader has the ability to recognize their volume patterns and uncover their tracks. Traders with volume expertise are in the enviable position of being able to take the lead or tailgate their positions. Measuring and charting volume data. Much as drivers assess coordinates before taking their vehicles off-road, we will be taking a preliminary look at how volume data are measured and charted. Volume is very versatile in that it can be used in its raw form, which is expressed and reads simply as volume bars plotted at the bottom of a chart, or in smoothed form, which uses a calculated overlay such as a moving average. These pure volume measurements can in turn be used alone, as components of other volume indicators, and in combinations, ultimately allowing us to gauge our trading terrain. Volume has been defined for charting purposes as the number of units traded during a given period of time. These units are typically represented by either shares or contracts. Volume is plotted with price to determine the strength or conviction behind price movement. There are several variations in the way this volume information can be displayed on stock and commodities charts. These different methods of display have their own strengths and weaknesses. Our trading time frame generally dictates our display preferences. This section explores some of the more common ways to exhibit and interpret volume information on common stock or other security charts. Bar plots. The most common method for plotting volume is the standard bar plot. The bar plot allows for quick analysis between price points to measure the strength or conviction behind a move. Chart 1.1 shows a simple bar plot of volume. Bar plots of volume can be either zero-based or based on the lowest volume total in a data or time series. In either case, a good bar plot gives the bars a consistent, uniform starting point, which makes comparisons between values easier. For instance, in Chart 1.1, notice how volume spikes higher at price lows on the chart. Later in the book, we will examine the meaning of these spikes and their implications for future price movements. Although the example in Chart 1.1 shows the trading of an exchange-traded fund ETF in the form of shares, we should note that such volume depictions also work for futures, which are sold as contracts, not shares. Chart 1.2 shows an example of volume expressed in contracts traded. Colored bar plots. One preferred way to enhance the display of volume is to color the volume bars. Many charting packages allow for the coloring of volume bars, making it easier to distinguish between days in which price closed higher and days in which price closed lower. Chart 1.3 has volume bars colored in black on days when price closed higher than the previous day, while days that closed lower than the previous day are colored in gray. Although our color choices in this book are limited to shades of black and white, other colors, most commonly red and green, can be used in most charting software. These color differentiations allow for quicker identification of positive versus negative volume. Simple line plot. The simple line plot is another method that is less commonly used for displaying volume. Rather than displaying volume bars, volume is shown as a line. Chart 1.4 shows a simple line plot for volume. Showing volume in this way can allow for a quick analysis of volume spikes and surge patterns. It will not work on more thinly traded, lower volume securities, as the line plot can be very erratic. Unlike the bar plot, smaller scale, shorter-term volume comparisons are more difficult to measure. Volume moving averages. The selection of a volume plotting methodology increases in importance when adding overlays to volume. One of the most widely used methods of analyzing volume data is with a calculated volume moving average, more commonly known as a VMA. A volume moving average shows the average number of shares or contracts that have been traded over a set period of time. In the NASDAQ 100 Trust ETF, QQQQ, Chart 1.5, a bar plot of volume also contains a 9-period moving average of volume, a common volume moving average setting for shorter-term traders. We'll discuss time frames in more detail in Chapter 7. Note how the volume moving average plots make it easy to spot the days where the daily volume jumped above the average. We've examined some of the different ways that volume data, the basic building blocks of volume analysis, can be displayed to accommodate a trader's charting preferences. Placing pure volume bars below price on a trading chart establishes that first reference point for volume analysis. In the remainder of this book, we will be taking a new perspective on the volume window and focusing on translating these volume bars, indicators, oscillators, and overlays into profitable trading signals and strategies. Summary. Volume has the ability to uncover the movements of larger market participants and track their footprints in the sand. Volume serves as a gauge of supply and demand and overall trading conviction, and is inextricably linked with price movement. Volume can be used to predict the direction, strength, and timing of those trends. Volume data, in conjunction with price information, may be charted in a variety of ways. The basic volume bar plot with a volume moving average VMA overlay is one of the most effective ways to chart the volume-price relationship. Chapter 2. The Trader's Mantra, Volume Precedes Price. The mantra that volume precedes price has served many a trader well and remains as much a fundamental truth today as it was when I first heard it more than 35 years ago. Price movements occur daily in the financial markets. Using volume analysis, we turn our focus on the volume action behind these movements and look for insight into the strength and intensity of the crowd that fueled the move. Although not all market participants are equivalent, the volume numbers continually reveal their collective sentiment. Market price trends do not happen in a vacuum. Rather, it is the behavioral or programmed responses of traders and managers that result in the volume shifts that precede a price move. As the crowd mobilizes, as reflected in the volume numbers, its size and conviction will determine the direction and strength of the price movement. As the conviction of the crowd falters and the volume numbers pull back and diminish, so too will this impact the timing and direction of the trend. This chapter displays some visual examples of this truth at work. Viewing the market in 3 dimensions. One of the major reasons for using volume analysis is to capture volume's ability to signal changes in trading sentiment to traders, which ultimately cause changes in trend or price direction. It helps to think of volume analysis as a multidimensional map of the trading environment. While price action looks at 2 dimensions, the inclusion of volume gives a visual look behind price movement, providing greater detail as to what the driving forces are and how they can be anticipated to behave. One way to think of this combination is to consider the situation of a mountain biker traveling through rugged terrain. Our biker can pack a simple flat map or one showing topographical features. A biker with a map of the technical features of the course will have considerably more information and be able to make qualitatively different decisions from a rider using a flat map. Our biker relying on a topographical map will be able to gauge the level of difficulty of the incline, the ruggedness of the course, and ultimately the time frame for completion. He will be able to access the amount of energy he needs to reserve for certain portions of the course. Sure, our biker might get from point A to point B with a flat map, but lacking information about the technical terrain could be both costly and life-threatening. Volume as a 3rd dimension, a brief example. The incorporation of a volume component into your trading strategy can be illustrated by a simple exercise. While sitting down, focus your eyes on a point in front of you in the room. Now cover one of your eyes. You should notice 2 things. First, your field of vision is cut in half as the peripheral vision on one side is completely gone. Second, covering one eye compromises depth perception. You've just seen how adding volume gives you a broader read on market activity, peripheral vision, while also allowing you to see intensity and conviction behind price movements, depth perception. Now let's consider the example of the iShares Dow Jones Real Estate Trust ETF, IYR, shown in Chart 2.1. The top frame shows a flat, 2-dimensional price momentum analysis. The bottom frame shows the Relative Strength Index, or RSI, a price-based momentum oscillator that is essentially a calculated figure representing the cumulative number of incrementally higher and lower closes in a given period. Even though the RSI is quite a sophisticated tool, the only input for its calculation is price data. Notice how, as price moves into the vicinity of its previous low, the 14-period RSI breaks down to a new low, which could be interpreted as an indication that the downside price action will continue. Now, let's examine the same price plot of IYR, only this time with volume bars plotted beneath price. The goal with this type of chart is to concentrate on the synergy between volume and price. In Chart 2.2, note how, as the iShares Dow Jones Real Estate Trust ETF, IYR approached the same price point shown in Chart 2.1, the volume action, which heretofore had been low, noticeably increased. Using volume analysis, a sharp-eyed trader would translate this as a battle for near-term direction. This type of increased volume action would be recognized as a signal that a change in direction was due. Rather than confirming the trend using RSI, erroneously, as it turns out, this multidimensional focus on both price trend and volume action suggests more correctly that a change in price direction was in the offing. It was only with the addition of volume that we were able to uncover the intensity and conviction of buying and selling pressure, and ultimately the money flowing into or out of the IYR index. This sort of multidimensional view reveals the power of volume analysis and the potential limitations of relying on price-based technical analysis alone. The three-dimensional view, a second example. This second example displays the S&P Select SPDR Financial Trust ETF XLF in its January to February 2010 decline. Equities were getting hit with a spirited pullback, but the buildup in volume on XLF as it made its January and February lows showed heightened activity that alerted traders that a change in trend was coming. First, in Chart 2.3, a price plot of XLF is shown using a one-dimensional price momentum study. The chart shows the price of XLF plotted with its 20-period price rate of change, measuring the momentum or strength of price movement. Note how the price indicator tumbled to new lows without signaling a potential reversal in trend. Contrast Chart 2.3 of XLF with a chart with its volume plotted below price, as shown in Chart 2.4. This added frame now shows that volume increased as price made its January 2010 low, rallied briefly, and then made its final February low. This volume action displayed a tug of war going on for near-term price direction. As the chart reveals, buyers eventually won the battle as price pushed higher into the spring. Conviction is what counts. Taking this discussion a step further, two-dimensional price momentum indicators can show overbought and oversold levels, but where they fall short is in their ability to display the conviction of the traders that pushed price to these levels. In classic technical analysis, one of the most commonly used price momentum tools is the stochastic oscillator developed by George Lane. The stochastic is an excellent and much relied upon banded oscillator that works well with volume indicators. However, many traders attempt to perform their complete trading analysis based upon its relationship to price movement. The following example shows how adding volume to this banded oscillator gives a trader a multidimensional and more accurate representation of a market trend. Chart 2.5, the Nasdaq 100 Trust ETF QQQQ, shows the stochastic oscillator and its behavior during the 2008 market meltdown. It reached the oversold level many times throughout the decline, but it really did not show the conviction behind each push into oversold territory. With a two-dimensional price oscillator, it is difficult to see any difference from one oversold instance to another. Analyzing the market using price alone did not provide essential trading information as to the sentiment behind these overbought or oversold market conditions. This is where volume comes into play, improving a trader's ability to interpret those conditions and ultimately to trade more efficiently and profitably. When volume and a volume-based indicator are added to the chart, it gives a visual display of the conviction behind the selling pressure during the 2008 price decline. See Chart 2.6 for QQQQ. We added the Force Index, a volume-based oscillator developed by Dr. Alexander Elder that is discussed in greater detail in Chapter 10. The Force Index uses volume data in its calculation and is able to provide a more accurate assessment of the trading terrain. While the stochastic indicator bottomed in the same range each time, the Force Index plunged to a deep low in September 2008, in the middle of the chart, which showed the intensity or conviction behind the selling pressure. The increase in volume showed that more crowd participants were contributing to the intensity of this decline. The depth of the September 2008 plunge in the Force Index could have been used as a comparison for determining that the second sell-off in March 2009 had less conviction. This provided an important piece of information for interpreting the March 2009 low. It signaled that sellers had exhausted themselves as compared to what happened during September's push lower. fact that the force index made a higher low, and volume itself was much lower, while price bottomed at the same level November 2008 and March 2009, showed that a change in trend should have been anticipated. The price-based stochastic oscillator indicated that the ETF was oversold. It was the added volume component, however, that revealed the crowd's lagging conviction and a strong probability of a reversal. Flash crash, a preliminary look at volume analysis. Here's another look at how volume analysis and a volume-based oscillator could have alerted traders that a change of trend was on the way. This example uses both price and volume-based oscillators leading up to the May 6, 2010, flash crash. See Chapter 6 for more details. Chart 2.7 once again displays the stochastic oscillator plotted just below price. This time the volume-based Klinger oscillator, see Chapter 10, is added to a plot of daily volume in the bottom frame. This oscillator is often used to spot long-term trends in money flow as well as short-term reversals. Note how the stochastic indicator topped at over 80, the overbought zone, several times, signaling that a short-term pullback could be expected. However, the stochastic indicator alone was unable to gauge the conviction of traders behind the move. The Klinger oscillator, on the other hand, painted a much different picture. While the stochastic oscillator was topping in the same area over 80 as price made its final top on April 26, 2010, the Klinger oscillator made a much lower peak. This served as a red flag that there was very little conviction behind the push to the new price high. This situation is known as a negative divergence between price and volume, a condition alerting a trader that a change in trend may be near. Such signals tell a trader at the very least to lighten up on equity exposure, as a pullback in price is expected. Also note the lighter volume in the bottom frame of Chart 2.7, confirming a diminished conviction behind the push into the April 26, 2010, high. This negative divergence displayed by the Klinger oscillator served as an early warning signal as price collapsed in the wake of the May 6, 2010, flash crash less than 2 weeks later. We've just seen how adding volume serves to complement more traditional price-based indicators and analysis. Volume analysis works well in a layered format. We will cover such overlays throughout the book and in particular in Chapter 11. Summary: volume analysis respects the relationship between volume and price. Adding volume is equivalent to adding a third dimension to your trading strategy. By using volume, we gain insight into the topography of the trend and the sentiment and conviction behind the price movement. Volume analysis can enhance trading profits substantially when utilized to assess trend strength, direction, and timing. The omission of volume can cause oversights and formidable errors. Chapter 3. Navigating the volume trading terrain. Developing a trader's eye for market direction requires recognizing the behavior of volume in price charting patterns. These volume patterns provide us with our first true snapshot of the trading terrain. In this chapter, we explore some basic and then more complex relationships between volume and price. Volume analysis requires the ability to identify how volume interacts with simple price charting patterns, specifically, how volume patterns precede and confirm price movement in trending and non-trending markets. Volume, when interpreted accurately, acts as a trader's navigation system, a daily amplifier of price movements revealing the strength and conviction of buyers or sellers that move price invariably into one of these charting configurations. Once we recognize the trading terrain, we will take these volume price patterns off-road, apply them to volume indicators and oscillators, and use them to discern a trade-worthy trend. 6 basic volume price relationships. Recognizing the basic relationship patterns between volume and price provides traders coordinates with which to predict future market movements and trends. Here are 6 such basic volume-price relationship patterns that every trader should know. The first 2 involve expanding volume, the second 2 deal with contracting volume, and the final 2 are concerned with static or constant volume. Expanding volume with price moving higher or lower when the market is in an uptrend, characterized by higher highs and higher lows, or in a downtrend, characterized by lower highs and lower lows. We see consistent conviction among traders, which displays itself as expanding volume in the direction of the trend. This increases the odds that price movement in the direction of the trend will continue. Chart 3.1 shows the price-volume relationship in an uptrending market. Expanding volume with minimal or no price movement, lack of price movement on expanding volume, such as exemplified in Chart 3.2, shows that buyers and sellers are struggling for control of market direction. We see this short-term sideways pattern in a trending market. It is an indication that counter-trend forces are building and that the movement of the trend is becoming labored, which puts the continuation of the trend in jeopardy. Typically, price trades in a range for a number of days in this type of pattern. Contracting volume with price moving higher or lower. When volume contracts as the price moves higher, see Chart 3.3, the volume pattern is not confirming the price trend. This means that the conviction behind the trend is not strong enough to attract new participants. The absence of new participants decreases the odds that the existing trend will continue. A reversal is possible. Contracting volume with minimal or no price movement. Lack of price movement on a pattern of contracting volume, as in Chart 3.4, shows that both buyers and sellers lack conviction that the price trend will continue. We see this trend in a consolidation phase. New participants are required to initiate a new trend. Consistent volume with price moving higher or lower price movement with a consistent volume pattern shows that buyers and sellers are in agreement that the trend should continue. Any transactions against the trend, sells in an uptrend or short covering on a downtrend, are a product of profit-taking decisions, not necessarily changes in sentiment. Chart 3.5 shows consistent volume as the price moves higher. Consistent volume with minimal or no price movement, buyers and sellers are in agreement that a stock, index, or commodity is fairly valued at its current price range. This is an example of a trendless market. Chart 3.6 shows consistent volume and little to no price movement. These 6 basic volume relationships can be used to gauge the market environment and increase the odds of a successful trading strategy. We will use them as a preliminary guidance mechanism upon which to interpret complex patterns. Traders choosing to employ volume methods should familiarize themselves with these volume-price relationships and their corresponding volume patterns. Patterns in a trending market, trend continuation patterns. The first task in our volume analysis is to identify the direction of the price trend. A plot of price, or an indicator that includes price, is a requirement. Once we make this determination, we can use an assortment of tools to determine how this trend will behave and how best to trade using it. One of the ways we go about this is to look toward traditional technical price chart patterns and their corresponding volume patterns. To accomplish our analysis, we place volume bars below price on our charts. Interpreting trend direction will provide insight as to whether the trend is bullish or bearish, and whether volume is expanding in the direction of the trend. Initially, these corresponding volume patterns can be used to confirm trends. Later, using volume overlays, we will examine these patterns in more depth and begin to predict how these trends will behave in the future. How volume confirms an uptrend. In a healthy uptrend, volume expands in the direction of positive price movement. There is a normal ebb and flow of higher highs and higher lows. This pattern is caused by traders selling profitable positions in the direction of the trend to new buyers. We can usually see profit-taking pullbacks, characterized by generally small decreases in volume as price drifts lower. Once the profit-taking has run its course, new buyers enter the market, creating a demand imbalance, i.e., more buyers than sellers and driving prices higher. A volume increase on trend resumption shows that the prevailing trend is in good health and is likely to continue. There are a number of trend continuation patterns that can give a trader a chance to jump on existing trends. More complex patterns are discussed in Chapter 4. For now, we will show an example of how volume confirms a simple bullish trend continuation based on a flag pattern. Chart 3.7 for IBM shows the characteristics of a series of bullish flag patterns that occur in strongly trending markets. The flag represents the shape of the pattern. Notice how volume dries up during the pullback, then explodes higher once the uptrend resumes. This is often the point at which traders trading in anticipation of the trend will enter their positions. It shows that buyers are in control and higher prices can be expected. How volume confirms a downtrend. The characteristics of trend continuation patterns in a downtrend are similar to those in an uptrend, the only difference being that volume expands on decreasing price movement, and the roles of buyers and sellers are reversed. Note in the example from J.P. Morgan Chase, JPM, in Chart 3.8 how volume contracts as price moves higher, then accelerates as the downtrend resumes. The low volume on moves higher can be thought of as a combination of short sellers locking in profits and some buying in anticipation of a bottom. Volume spikes, sudden aberrations in volume, are much more prevalent in downtrends than in uptrends. Sell-offs are typically more emotional events as traders unload their shares, either by decision or through stop-loss orders, in an attempt to avoid further pain in a losing position. Indecision or rest, consolidation patterns. The basic premise behind consolidation patterns is that traders are entering a period of indecision or resting, which can be translated into a lack of price direction. This pattern consists of a well-defined pattern of price containment, known as support and resistance. The consolidation period ends when price breaks out over either the support or the resistance level. Volume plays a key role in validating or refuting the breakout. This type of price pattern will occur with a simultaneous pattern of volume contraction. It appears that traders who have participated in the trend up to the consolidation point are content to hold their positions. At the same time, there isn't enough excitement or energy among new participants to resume the trend. This results in some interesting patterns or shapes, the most common of which are the triangle and flag patterns. Triangle consolidation. The triangle is probably the most widely recognizable consolidation pattern. Chart 3.9 for the iShares COMEX Gold Trust ETF JAO is a classic example of a triangle pattern and trader indecision. Notice how price in the early part of the chart exhibited a strong uptrend, then took a breather as it was compressed into a triangle pattern on declining volume. That showed a lack of conviction among buyers in the direction of the trend, yet at the same time selling pressure was weak. Volume continued to contract as the triangle formed, then exploded higher on the breakout, which signaled a resumption of the uptrend. Flag consolidation. Consolidation patterns in both uptrends and downtrends have similar characteristics. In most cases, consolidation patterns are resting phases before the previous price trend resumes. In Chart 3.10 for iShares Cohen and Steers Realty Trust ETF, ICF, we see a bearish flag consolidation during a weak countertrend, push higher before the downtrend resumed with a vengeance. Notice how as each flag formation developed, price labored to push higher in a choppy, low-volume pattern. Once the weak buying action concluded, sellers re-established their dominance, and the downtrend resumed. Note that in Chart 3.10, if you weren't specifically looking at volume, you would have no idea whether the price would continue in the upward direction indicated by the flag or in some other direction. The volume bars provide an additional dimension in this case. Declining volume shows the lack of conviction and thus a weakness in the push higher. Volume tells us that we're in a consolidation phase, and it may also signal how prices will emerge from that pattern. Volume patterns in sideways markets. When a market is trending upward, i.e., making higher highs and higher lows, or downward, i.e., making lower highs and lower lows, it is easy to glance at a chart to see whether buyers or sellers are in control of the market. What about trendless markets, those moving sideways or within a trading range? Volume can give important clues as to who is winning the supply-demand battles, which can help us anticipate the direction of breakouts from the range. A range-bound market, i.e., a market trading in a fairly definable range, is a great place for larger entities, such as mutual funds and hedge funds, to accumulate shares. Securities become range-bound for a RIA-SUN. The upper boundary is seen as the most that traders are willing to pay, which encourages selling, while the bottom end of the range is seen as a good value, which brings in buyers. The behavior of price and volume at these levels gives insight as to the activity of these larger players. Here you can observe their footprints in the sand as a function of the flow of money into and out of the security, with an accumulation of shares in anticipation of breakouts in the trend. Also, it is within these boundaries that the high-frequency trading players and swing traders make consistent and profitable trades. Bullish accumulation pattern. In Chart 3.1, for Cisco Systems, Cisco, note how price moved higher out of its July 2009 low to establish a new range. The volume pattern in this range shows that shares were being accumulated as volume picked up, while price moved higher off of the lower end of the range. This accumulation pattern, repeated 3 times, preceded an upside breakout of the range in March 2010. Bearish distribution pattern. The pattern just described can happen in reverse. Price and volume behavior in the range takes on a more bearish tone as sellers apply more pressure than buyers. This shows that the security is being distributed, that is, sold off, especially by large players rather than accumulated. These types of distribution patterns are typical after strong up moves, while less sophisticated traders are still excited and willing to buy the security being distributed by the larger players, mutual funds, hedge funds, etc. Chart 3.12 for the Euro FX composite shows how volume picked up at the peaks as price turned lower within the range. This volume pickup was an indication that there was more overhead supply than the market could bear. So from a simple supply and demand viewpoint, price had to adjust lower to compensate for the supply-demand imbalance. Note also in Chart 3.12 how volume exploded when price broke down out of its range. That was a sure signal that sellers had assumed control and that the euro was headed lower. Patterns in a trend reversal. A reversal pattern is a price and volume pattern that can alert a trader that a change in price direction is imminent. These patterns take time to form, and volume plays a very important role in their identification and validation. An example of a reversal at a top or a bottom is the spike pattern. We will be examining the many reversal patterns in greater detail in Chapter 5. Volume spike pattern at market highs and lows. Volume spikes are emotion-driven events that signify that buyers or sellers may have exhausted themselves in one direction or another after an extended move. Depending upon where in the trend a volume spike occurs, a trader may be able to either reaffirm the existing trend or be alerted to a potential change of direction in the market. While rising volume is good for the strength and sustainability of trends, too much volume in a strongly trending market can be a warning sign that a change is about to occur. In order for trends to continue, there needs to be a constant, key word supply of new participants who want to take positions in the direction of the trend. An abundance of new participants shows up in expanding volume totals in trending markets. If, however, volume spikes to levels much higher than anything seen during the uptrend, it is a sign that buyers have exhausted themselves, or that a larger than normal number of buyers rushed in to purchase shares, leaving fewer new buyers willing to support the trend. This makes markets vulnerable and can cause them to correct, as the selling pressure created by profit takers is not met with an equal or greater number of new buyers willing to participate. The Nasdaq Composite example in Chart 3.13 shows volume spikes that led to short-term tops in the market. Volume spikes are also good for identifying short-term market lows, particularly after extended moves. Increasing volume on pullbacks can be an early sign of a trend change, but patience in reacting can be the key to jumping on a great buying opportunity. Steadily increasing volume on sell-offs is typically a bearish sign, while spikes on sell-offs can be an indication that sellers have exhausted themselves to the downside. In either case, price movement can be expected as volume settles back to normal levels and the market resets. In Chapters 8 to 10, we will look at some other volume indicators that are used to identify changes in volume behavior. For an example of price bottoms indicated by volume spikes, see Chart 3.14 for the Energy Select SPDR Trust ETF XLE. Divergences between volume and price. Divergences between price and volume occur when price is trending upward or downward, but volume is decreasing. This behavior shows that volume is not confirming the trend. Divergences show traders that conviction behind price movement is lacking, which means that the odds of a trend reversal increase. Including volume in chart analysis can give a trader a quick, clear snapshot of the extent of buying or selling pressure in trending markets. As price trends higher or lower, volume should also be expanding, showing a higher level of participation among traders. If volume is contracting while price is trending upward or downward, it is a signal that either a price correction or an all-out trend change may be imminent. Since volume is the fuel needed to sustain price direction, think of falling volume as moving closer to empty on the gas gauge for that price movement. For instance, volume helps to discern the lessening conviction behind a downtrend. The Consumer Staples Select Sector Trust ETF XLP example in Chart 3.15 shows how volume contracted during its 2008 downtrend. That was an indication that there were fewer and fewer sellers as price declined, thus opening the door in March 2009 for buyers to assume control and take XLP higher. Up to this point, we have explored the 6 basic volume-price relationships and seen some simple examples of the types of price patterns that traders encounter in trending and non-trending markets. Watching volume patterns in action, we see how they serve to affirm continuation, consolidation, range-bound, and trend reversal patterns. Summary: there are 6 basic volume-price relationships. These basic relationships form all or part of more complex volume-price patterns. Essentially, volume action can confirm or refute price patterns in trending and trendless markets. Volume can be anticipated to behave in certain ways under specific trading conditions. If a corresponding volume pattern does not confirm the price trend pattern, the sustainability of the trend is in doubt. Divergences between volume and price can give traders some of the clearest signals of possible trend changes and reversals. Not all increases or expansions in volume indicate price trend changes in the same way. Depending upon where in the trend a volume spike occurs, a trader may be able to either reaffirm the existing trend or be alerted to a potential change of direction in the market. Chapter 4. Spotting volume price patterns and market trends. Volume shows how many shares or contracts changed hands between buyers and sellers over a set period of time, e.g., an hour, a day, or a week, and provides insight as to the strength and sustainability of the trend. While the actions of market traders can be summed up in daily price movements, volume reflects the conviction behind the move. Volume can be thought of as the collective sentiment of the market. In volume analysis, we see a graphical representation of the supply and demand relationship displayed in our volume measurements. If price is trending with less conviction, i.e., declining volume, a change in sentiment may be underway that favors the odds for a change in direction. In contrast, if price is trending with stable or higher conviction, i.e., steady or increasing volume, the trend can be viewed as healthy and sustainable. Leaving volume out of the picture does not provide the depth of analysis necessary to make informed trading decisions. All that said, just as with price, the signals provided by volume aren't always easily observable. Many textbook examples of volume confirming price trends shown in the last several chapters occur in real life and are easy to find for traders doing their homework. But that would be too easy. If all volume signals were obvious, all traders would recognize them and trade with them, and in the end, they would no longer work. So it becomes important to deploy more sophisticated ways to detect trends in volume and translate volume price behavior. This chapter begins to describe some of the more complex volume behaviors, those of consolidation continuation patterns, and how to spot them over time. We also focus on using volume overlays, supplemental volume indicators, to more clearly display the volume trend in conjunction with price. Chapter 5 gives the other side of the coin, identifying trend changes or reversals using similar tools, using overlays to spot and assess volume trends. While a normal daily bar plot of volume can seem erratic and without pattern or trend, there are methods that can be used to detect trends in volume that are not readily apparent to the naked eye. This type of volume trend analysis is best accomplished through the use of overlays. Overlays are indicators plotted over the top of price or volume bars with the same value scale. Such overlays are more commonly used with price plots, but using them with volume can display the corresponding volume activity for a given market trend. As volume precedes price, confirmation of a price trend expanding volume in the direction of the trend means that the trend is likely to continue, while non-confirmation of a price trend means that the trend is suspect and likely to reverse. In this section, we take a look at three types of volume overlays: volume moving averages, VMA, linear regression lines, and volume moving average convergence divergence MACD of volume. Volume moving averages. A volume moving average shows the average volume, number of shares or contracts that have been traded over a set period of time. The purpose of a moving average is to smooth out volatility or noise, which can be confusing and can compromise proper market analysis. This allows traders working within a preferred time frame to see if volume for a price move has been heavier or lighter than normal, which, in turn, can result in different interpretations of that price movement. Since higher volume totals show more conviction behind a price movement, days that have above average volume are more meaningful than days that have below average volume. Moving averages come in many different types, such as simple, exponential, weighted, time series, and triangular. For the purpose of this first example, we will use a simple volume moving average SMA. A moving average is constructed by summing the past n periods of volume and dividing by n. For example, if an intermediate time frame setting using a 20-day period moving average of volume is desired, add up the last n equals 20 days of volume and divide by 20. This gives an average volume total of the last 20 days that provides a much smoother graphical representation of volume than the sometimes erratic readings that can occur from day-to-day bar plots. Such a moving average allows a trader to see whether volume is increasing, the sign of a healthy trend, or decreasing, the sign of a suspect trend. Any competent charting package will let you overlay volume with a moving average in a couple of mouse clicks. One of the most commonly used moving averages for volume analysis is the 50-day volume moving average, VMA, which is good for a higher degree trend analysis. There is one disadvantage to using this longer-term moving average. It tends to be slower to respond to changes in volume trends. For this reason, it's important that the time frame settings for the VMA match your time horizon as a trader. Chart 4.1 for JP Morgan Chase, JPM, shows how a 50-day VMA is used to confirm a downtrend, showing that sellers are clearly in control. Chart 4.1 shows a rising pattern of volume bars, but the 50-day VMA overlay displays the volume trend more clearly. Note that as the 50-day VMA drops older and adds newer periods, it is still less responsive to current changes in volume. This was demonstrated by the 50-day VMA rising while volume tailed off in April. The longer the averaging period of the VMA, the slower the moving average is to respond to change and the greater the lag effect. This means that shorter time periods for the VMA, 5 to 10 days, are much more sensitive to volume fluctuations than the longer-term VMA, 50 days. The trade-off, thus, when setting in is between its sensitivity to most recent volume data and the timeliness of its signal. Longer end periods mean a smoother trend line but also more lag. The VMA is an excellent tool for capturing the patterns of greater than normal or escalating periods of volume. These patterns of increased volume activity typically precede a reversal in price, depending upon where they occur in the price trend movement and on what side of the trend they occur. Ultimately, The time frame setting you choose for your VMA will determine its sensitivity to the volume trend. Depending on the length of the settings, the VMA can detect escalated activity in volume above the norm over the short term, up to 10 days, intermediate term up to 50 days, and long term 50 days and more. This allows a trader to determine the volume norm and detect these surges in volume within a preferred trading time frame. The exponential moving average of volume gives more weight to recent volume values, thus increasing its sensitivity as compared to the simple moving average. This is discussed in more depth in chapters 5 and 7. The 60-minute view of Apple Inc., Trading MPL in Chart 4.2 shows how intraday surges in volume can be detected using a 7-period VMA. Notice how the volume surges and coincides with short-term turning points that can last for a number of days. Escalating periods of volume that occur over a slightly longer time frame have more of an impact on price direction. The daily record of Apple Inc. in Chart 4.3 uses a 5-day VMA to detect short-term volume surges that can lead to reversals in the intermediate term that last anywhere from 1 week to 3 months. Higher degree trend changes can be detected by using an even longer VMA to detect volume surges. In Chart 4.4, a daily record of Apple Inc., a 20-day VMA is used to detect intermediate-term volume surges. These surges can affect price for periods up to 3 months or longer. Note how the October 2008 surge tipped off traders that a bottom was near. It took the bottom 5 months to form because of the extraordinary market events unfolding at that time. The October 2008 volume surge alerted traders that buyers were stepping up to defend the $80 level, which provided support until the broader market turned in March 2009, allowing Apple to begin its strong uptrend. Linear regression overlay. A linear regression line can also be used as a volume overlay to show volume trends more clearly. Linear regression analyzes the relationship between two separate variables in order to define a single relationship that is plotted as a straight line in this instance, volume and time. As volume totals can be very erratic from day to day, a linear regression line provides a straight trend line that can easily be interpreted if a trend is indeed present. Linear regression is a tool that is available with more advanced charting packages. If you have the ability to add a linear regression line, it can provide an easy at-a-glance interpretation of the trend and the strength of the trend. The linear regression overlay LRO is interpreted similarly to a moving average, but it has two distinct advantages over moving averages. First, unlike a moving average, a linear regression indicator, LRI, does not exhibit much lag. Second, since the indicator is not averaging volume, but rather fitting a line to the data points, the linear regression line is more responsive to volume changes. Chart 4.5 for JP Morgan Chase shows a daily time frame from April 2007 through April 2008. In this instance, a linear regression line instead of a moving average has been plotted. Notice how straight and clear the linear regression line is compared to the previous moving average example. Moving average convergence divergence using volume, the MACD price momentum indicator, was developed by noted technical analyst Gerald Appel. Unlike the previous two overlay examples, the MACD of volume uses its own volume scale rather than sharing the volume scale used for individual volume bars. It is included in this overlay section, however, because its plot not only closely mirrors that of the volume bars, but also can give insights into volume momentum that are useful to traders employing a shorter time frame for their analysis. The MACD is a trend following momentum indicator using the difference between a 12-day exponential moving average and a 26-day exponential moving average to compute a singular daily value. An exponential moving average, EMA, is a technique for weighting more recent data more heavily in the averaging calculation. A 12-day EMA gets more weight from the most recent values, and thus is more sensitive than a 26-day EMA. The difference between the two numbers indicates direction and strength. The raw MACD figure, in turn, is normally plotted with its own 9-day exponential moving average, which is known as the signal line. Crosses above the signal line on the MACD show that volume momentum is building, while crosses below show that volume momentum is slowing. Also, MACD values above zero are viewed as having positive momentum, while values below the zero line are viewed as having negative momentum. The volume MACD can be used to pinpoint where volume momentum is peaking in relation to price. For JP Morgan Chase, JPM in chart 4.6, note how the MACD peaks at price lows, the solid black lines, and troughs at price highs, the dotted lines. This showed that volume momentum was building on sell-offs and diminishing on rallies or consolidations. This is another method of showing that sellers were in control during this time frame and that the downtrend was likely to continue. Confirming trend strength, robust trends. In Chapter 3, we presented a brief overview of the market trends and volume price patterns you will encounter as a trader. In this chapter, by using volume analysis, we will take a more in-depth look at the trading terrain with a focus on consolidation continuation patterns in trending and sideways markets. In Chapter 5, we will focus on reversal patterns. Once we've determined the price trend direction, we will take a read on that trend. Price trend direction can be determined using the price plot, price bar, price indicators, or a moving average. Our volume analysis here will focus on the volume that precedes and confirms that trend. A robust trend is one that is showing a discernible trend in price, whether up or down, along with a simultaneous expansion in volume. Volume levels show how strongly market participants feel intensity, sentiment, and conviction about the future value of a security, whether the perceived value is higher or lower. Confirming robust trends with VMA, linear regression, and MACD. Chart 4.7 for Newmont Mining NEM shows how the rising 50-day VMA confirmed the strong uptrend in price, signaling that this was a robust, healthy trend. This is a classic example of demand overwhelming supply, which is shown by the rising price and rising volume trend. Chart 4.8 shows a linear regression plot line of volume for Newmont Mining. The rising slope of the line is an indication that more buyers are entering over the entire period, reinforcing the upward price movement. Note again how straight the regression line is and how easy it is to interpret. Finally, we show how a volume MACD can be used to confirm robust trends, in this case an uptrend. NEM in chart 4.9 is an example of the MACD of volume during the same uptrend. Note how the MACD peaks at short-term market tops the dashed lines and crosses below the MACD zero line during corrections, the solid lines. This shows strong buying pressure on rallies and weak selling pressure on pullbacks. Carrying the example further, everything seems fine with the uptrend until NEM breaks out to even higher highs in early 2006. Notice how the MACD of volume is much weaker on its pushes higher as price moves sharply higher. This was an indication that the uptrend was in its latter stages and that there were fewer buyers to support the trend. It would have been a prudent time to lock in profits. If we view the end of chart 4.9 and move forward, see chart 4.10, we can see what followed the MACD of volume warning just described. Price pushed to new highs, but the MACD of volume failed to confirm the price action, indicating that buying pressure was slowing. NEM then corrected over 22%, demonstrating the value of the MACD warning given. Confirming trend weakness, lagging trends. Since volume most often precedes price, weakening volume during a trend shows that traders lack the conviction necessary to keep the trend moving. This lack of conviction eventually shows up in reduced buying or selling pressure, which can spell doom for the continuation of a trend. This type of divergence is especially noticeable in uptrends. In an uptrend, as price climbs higher, more buying pressure is needed to sustain the move. Consistent or increasing volume is the signature of a robust trend. But if a security reaches a point at which those who plan to buy have already purchased their shares, the volume begins to weaken or lag, and simple profit-taking can cause the beginning of a serious correction. Johnson & Johnson J&J, In chart 4.11 is an example of a lagging uptrend, as volume is weakening throughout the trend. Notice how the 50-day moving average of volume is drifting lower as price rises. The declining volume during the uptrend indicates that fewer buyers are participating as prices appreciate. That situation leaves the door open for a nasty decline, as the chart illustrates. As evidenced in chart 4.12, a MACD overlay of volume can be a great short-term momentum tool to show the strength of volume pushes at various stages of a trend. Volume MACD can also be used to show lagging trends. Remember, when the MACD is below the zero line, it is in a weak position, and when it is above the zero line, it is in a position of strength. In chart 4.12 for Johnson & Johnson, note how the MACD of volume showed weakness below the zero line as price pushed higher. Then, note how the volume MACD spiked once sellers took over. Trendless markets, volume patterns at support and resistance levels. As we discussed previously, a trendless or sideways market usually moves between upper and lower price boundaries. These boundaries are known as support, the lower boundary, and resistance, the upper boundary. Volume characteristics around areas of support and resistance help to predict the future direction of the trend. Volume accumulation at support. Support can be thought of as the lower boundary of what is perceived as good value for the security between buyers and sellers. As price approaches the lower boundary support level, either buyers accumulate shares or selling pressure diminishes. In either case, prices are prevented from falling any further because of value that is perceived for the time being at that price level. Support levels can be easily identified on a chart by simply connecting the daily price lows during a particular time period. The level at which buyers enter is usually more of a tight price range near the support level than a specific price target. Even though the dynamics of support zones are such that good value is seen at that price, there is no guarantee that the support level will hold. If it is broken, that is a sign that the sellers have won the battle by bringing more supply than the market can bear, causing price to adjust, sometimes sharply, to lower levels. As price approaches the support area, volume behavior can give clues as to the actions of the larger players, such as institutions and hedge funds. If volume increases and the price support area holds, this demonstrates buying interest at that level, which is usually a clue that the larger players are accumulating shares or contracts. Chart 4.13 for Barrick Gold ABX shows how volume increased repeatedly as price approached the support area. The fact that volume increased and price reversed higher off support showed that the buying pressure at support was enough to create an imbalance on the side of demand over supply, which then pushed prices higher. Instead of continuing to purchase shares, however, buyers were content to let the price drift back down to accumulate shares again at a price level seen as a good value. After repeating this relatively bullish accumulation, the trendless pattern was broken as volume increased sharply with a strong price move to $48 after the period of accumulation in the $27–28 range, when accumulation at support fails. While chart 4.13 for Barrick Gold shows how shares are being accumulated as price bounces higher off of support on increased volume, there are other times where there is no evidence of buying at the support level. These situations can lead to breaks below support or sharper price breakdowns. Citigroup C in chart 4.14 is an example of a price support around the $45 area. Notice how, as price moves lower and approaches the support line, the action volume is much more subdued than in the previous example. There are some minor pops higher in Citigroup's volume, but nothing that shows that a real battle between buyers and sellers is taking place. Finally, notice how volume picks up in mid-October as price falls, indicating a new supply of shares entering the market. Since there was not enough demand to absorb this new supply, price adjusted lower by breaking down through support. Volume distribution at resistance. Resistance is a price boundary where supply levels prevent price from rising any further. The price at resistance is seen as the upper boundary of what is perceived as good value by traders. The most common method for determining the boundary range for resistance is to draw a line through an equity's respective highs during the time frame under analysis. A second method is to compare the amount of volume at a given price point with the amount of volume that was traded the last time it reached that same price point. If volume was greater on a previous attempt, then the resistance may be inferred as holding. Conversely, if volume was less on a previous attempt, then resistance may be failing, and a breakout could be imminent. As price reaches a resistance level or zone, either sellers take profits or buying pressure diminishes. Distribution at resistance is accompanied by an increase in volume over the previous day without price appreciation. If price is to get through a resistance area, a large enough increase in volume is needed to absorb the overhead supply. If volume does not increase to provide the fuel necessary to push through resistance, then either price will remain in a trading range or sellers will take over and drive the price lower. IBM in Chart 4.15 gives a great example of a resistance area that needed an increase in volume to push through. Notice how volume was weak throughout the time that resistance held in the $77 to $78 area. That signified that there was not much conviction or passion among buyers or sellers. Once buyers decided that the prospects for IBM made it worth more than $78 per share, they entered the market and provided enough buying power volume to absorb the overhead supply of shares, which in turn allowed IBM to move significantly higher. The IBM example in Chart 4.15 was a happy ending for those buying IBM stock, but what about the other side, or when sellers overwhelm buyers? Remember, a resistance level is in place because there is more supply than demand at that price. If there is not enough conviction among buyers to push the price higher, then prices will ultimately move lower. Chart 4.16 for KLA Tanker, CLAC, shows how the dynamics of price and volume around a resistance area can give clues to whether or not that resistance area is likely to hold. Notice how in October 2009, KLA Tanker made a price high on solid volume in the 37.50 area. After a good sell-off, price once again approached the 37.50 level in December, but this time volume was much lighter. If nothing had materially changed for KLA Tanker over the previous couple of months, chances were that 37.50 would still be viewed as the upper end of fair value for the stock. If sellers were going to emerge at that level, the lighter volume in December was a clue that there may not have been enough demand at 37.50 to push price through that level. Sure enough, after churning sideways for about 3 weeks in December at resistance, volume picked up as price fell. There was already some evidence that there was not much demand interest at this level, as demonstrated by the low volume. That opened the door for selling pressure, or a new supply of shares coming onto the market to drive prices sharply lower. Notice how the increase in volume showed that change was on the way in the form of increased selling activity. This is a good example of how volume precedes price. Volume in action. Trend consolidation continuation chart patterns. In this section, we will take a look at how volume behaves during a trend consolidation phase and breaks out in a continuation of the previous trend. We explore the corresponding volume patterns of some of the more widely recognized price chart patterns used in trading today. Volume behavior in pennants. A pennant is short-term in nature, usually lasting from 1 to 12 weeks, and normally reflects a brief consolidation before the continuation of the previous trend. Since this pattern represents short-term consolidation and trader indecision, it can on very rare occasions be a reversal pattern, as will be shown in Chapter 5. But the overwhelming majority of the time it represents a short pause before the prevailing trend resumes. This pattern typically forms at the midpoint of a move and occurs after a sharp price advance or decline, depending on the trend direction, on heavy volume. A breakout of the pattern on an increase in volume signals that the trend is resuming. Chart 4.17 shows an example of a pennant pattern for Cisco Systems, Cisco. The pennant pattern is formed by price fluctuations within a range, and it needs at least 2 touches each on the resistance line and the support line to be valid. The pennant formation is recognized by its symmetrical triangle shape, with price action being compressed as the pattern matures. Note that the flagpole is an important component of the pennant formation. It is the distance from the break of either support or resistance, depending on trend direction, to the high or low of the pennant. The flagpole must be formed on heavy volume to validate the pattern. Once the pattern is validated, the length of the flagpole is used to compute a price target for the move. Chart 4.17 shows a bullish pennant formation, its characteristics, and how to compute a price target. 1. The price move starts at the $18 price level in July 2009. 2. Price rallies sharply, breaking through resistance at $20.35 and hitting a high of $22.74 before the consolidation begins. 3. Once a valid pennant forms with at least 2 touches on each boundary line on contracting volume, a calculation of the length of the flagpole can be done as follows in order to set a trading price target. A. Measure from the point of the breakout over resistance, $20.35, to the top of the initial rally, $22.74, and subtract the breakout level from the high, $22.74, minus 20.35 equals $2.29. The computed value, $2.29, is used on the breakout of the pennant formation to project the price target. B. Once price breaks out of the pennant formation on heavy volume, add the length of the flagpole, $2.29, to the price at the point it broke out of the pennant, in this case $22.35, to get the trading price target of $24.64. Volume behavior in flags. Flags are also short-term in nature, lasting from 1 to 12 weeks. A flag is a small rectangular pattern that develops against the prevailing trend. For example, if the trend is up, the flag forms in a downward sloping manner, a bull flag, and vice versa for downtrends, a bear flag. As with pennants, the pattern develops between a support and a resistance line. The flag differs from the pennant in that the flag is defined and contained by 2 parallel lines, while the pennant features 2 converging lines. Volume is a key component in the development of the flag pattern. The flag formation also needs a flagpole, which must be formed on an increase in volume. Next, volume must contract as the flag pattern forms and matures. Finally, volume must confirm a breakout of the pattern by increasing noticeably at the point of the breakout. Chart 4.18 for iShares Barclays 20-plus year Treasury Bond Trust ETF TLT shows a bearish flag formation, its characteristics, and how to compute a price target. 1. The price decline starts in the $106 area in early April 2009. 2. Price breaks down through support at $100.38 on an increase in volume, before finding support at $94.33, which is where the price consolidation begins. 3. Price then rises between 2 parallel lines, forming a channel or bearish flag against the trend. 4. Once the bearish flag formation is realized, you can compute the length of the flagpole by subtracting the low point of the flag, $94.33, from the support line that was broken, $100.38, which gives a flagpole length of $6.05. 5. Price breaks down out of the flag formation at $96.70 on increasing volume, which validates the breakdown. 6. The length of the flagpole, $6.05, is subtracted from the breakdown point, $96.70, to project a price target of $90.65. Using flags and pennants in practice. As with other patterns, suspected flag and pennant formations can be misleading if you don't carefully follow a few rules. Here are a few key points to remember about flag and pennant formations. 1. The price action before the flag or pennant forms must be a strong move with healthy volume. This action forms the flagpole. 2. The pennant forms a symmetrical triangle pattern while the flag forms against the trend in a channel between 2 parallel lines. Volume contracts as the patterns are formed. 3. The pattern becomes valid when there are at least 2 touches on the upper and the lower boundary lines. 4. A breakout of the pattern is validated or confirmed by an increase in volume. 5. The length of the flagpole is projected from a break of either support or resistance to either the high or low point of the formation, depending on the direction of the trend. 6. The length of the flagpole is projected from the breakout point of the pattern to generate a price target. Volume behavior in triangles. Triangles are patterns created during consolidation phases, representing a pause in the prevailing trend before continuing in the trend direction. They form in a horizontal consolidation that reflects diminishing interest in trading a particular security. In order for any triangle pattern to qualify as a continuation pattern, there must be a pre-existing trend in place. A triangle is formed with at least 2 touches on each of the converging support and resistance lines. As with the previous consolidation continuation patterns, volume is lackluster while the triangle forms. An increase in volume is used to confirm or validate the breakout of the pattern. Triangles come in 3 forms: 1. Ascending, 2. Descending, 3. Symmetrical, ascending triangles. An ascending triangle is a bullish pattern that has a flat top line representing resistance and an upward sloping bottom line representing support. The pattern consists of at least 2 highs at or near the same price level, with higher lows made on each rally attempt. The higher lows on each decline show diminishing supply or selling pressure on each push lower, which causes the upward sloping support line. Volume should be lower than average and or be decreasing as the pattern develops, and the price action is compressed. Chart 4.19 for Euro FX Composite illustrates the ascending triangle. Notice the flat resistance line and the upward sloping support line. The resistance level was set at $1 and 23.59 cents on the January 2006 high. Price declined after that, and the consolidation process started as price made a series of higher lows with each decline. Price then made another attempt to break through resistance at $1 and 23.59 cents, but was temporarily turned away, resulting in one final touch of the support line. The next attempt to break out was successful, as volume increased, showing an increase in demand, which caused price to reset to a new higher level as the trend resumed. Descending triangles. A descending triangle is a bearish pattern because it appears primarily in downtrending markets. In contrast to the ascending triangle, it consists of a flat lower line support and a downward sloping top line resistance. The pattern consists of at least 2 lows at or near the same price level, with lower highs made on each rally attempt. The lower highs on each rally attempt indicate diminishing demand on each push higher, thus causing the downward sloping resistance line. Volume should be lower than average and or be decreasing as the pattern develops, and the price action is compressed. Chart 4.20 for AMR Corp shows a descending triangle. The initial low of the pattern was made at $10 in March 2004, with a test of that low coming later that year in May. That formed the flat support line in the $10 area, which was the level to watch for a break lower. Notice how, as the pattern formed, price made a lower high on each rally attempt, which allowed a downward sloping resistance line to be drawn by connecting the highs. Volume was rather lackluster as the pattern developed before price finally broke lower with increased volume in July as the downtrend resumed. Symmetrical triangles. A symmetrical triangle is very similar to a pennant formation because it involves the same basic shape. Symmetrical triangles, however, are longer in duration since they represent a longer-term period of trader indecision. The consolidation period shows an absence of conviction from both buyers and sellers, thus allowing supply and demand to appear virtually equal as price consolidates sideways. Volume should be lower than average and or be decreasing as the pattern develops, and price action is compressed. Chart 4.21 for Google Goog shows a symmetrical triangle pattern that formed following a sharp rally. The pattern lasted for 8 months, however, as lack of demand was matched by a lack of supply. Notice the pattern of lower highs and higher lows as the support and resistance lines converge. Volume moved higher as demand for Google shares finally forced the price higher to break out of the triangle. The breakout was upward in continuation of the previous trend, and the increased volume validated the breakout direction. Volume confirmation of trend continuation patterns. These patterns can appear both in trending markets and following consolidation patterns. They reflect the resumption or continuation of a trend in its most recent direction. Continuation gaps. Gaps are just what the name implies: a large step up or down in price, forming a gap from the previous position on the chart. Most commonly, the term is used in the context of a gap open, where the price opens substantially above or below the previous closing price. A continuation gap occurs in the middle of a move and in the same direction as the existing trend. Unlike exhaustion gaps, continuation gaps make good trade entry points in the existing trend, as these patterns are a signal that buying or selling interest has accelerated. These gaps are also known as measuring gaps or runaway gaps. Chart 4.22 for Amazon.com, Amazon, shows a continuation gap in an uptrend. Notice how price moved higher off the November 2008 low before forming a bullish flag pattern as price consolidated. On January 30, 2009, price gapped higher on huge volume, signaling that the newly formed uptrend was ready to continue. Candlestick continuation patterns. Candlestick charts have become one of the more popular tools of both the trader and the serious technician. The candlestick charting method was developed in Japan in the 17th century. Greg L. Morris introduced the software methodology to traders in the United States back in the early 1990s. As the story unfolds, a Japanese rice futures trader noticed that in addition to supply and demand, trader emotion played a large part in market behavior. This emotion could sometimes cause a disconnect between the price and the actual value of the rice market. The candlestick methodology was developed in an attempt to graphically represent intraday price relationships that were driven by trader sentiment. Candlestick charting is very popular among active traders because it reflects short-term outlooks, usually less than 2 weeks in duration. Chart 4.23 shows the components of a candlestick. The difference between standard bar charting and candlestick charting is that the real body of the candlestick shows the relationship between the open and close for the period. If the close is higher than the open, the real body is hollow or white. If the close is below the open, the real body is darkened, whether it is black, red, or whatever color the chartist chooses. That is a very simplistic overview of how candlesticks are constructed. Candlestick charting is a very complex topic and beyond the scope of this book. One example of a common candlestick continuation pattern that is especially common in the foreign exchange (FX) market is interestingly named the in-neck thrusting pattern. The example of the E-mini Euro FX futures contract in chart 4.24 shows the in-neck thrusting pattern as it unfolds during a downward move. Note that most candlestick patterns are short-term in nature, so they develop quickly. Chart 4.24 illustrates the pattern in a downtrend, but this pattern is also valid in uptrends as well. In the downtrend example in chart 4.24, the pattern unfolds as follows. Day 1 consists of a long black candle signaling the conviction among sellers. Day 2. The candle has a white body, which means that the closing price is above the opening price as buyers step in to try to stem the decline. This candle usually has a long tail, which signals that there was a strong battle to push price lower, but for this day the buyers prevailed. Day 3. On the third day, buyers attempt to push price higher but fail, and the sellers resume control, which results in another large black candle resuming the downtrend. Volume increases throughout the pattern, showing a definite battle for control of the market. In this case, it was ultimately won by sellers. This chapter has presented volume overlays as a way to detect and assess trend strength. We have also learned to identity and confirm price chart formations using their corresponding volume patterns to predict continuation in trend direction. Summary. Volume allows traders the opportunity to see how much intensity or conviction is behind price movements of individual stocks or the market as a whole. In a sense, volume validates price movements and can also give insight as to whether a trend is likely to continue or change direction. Keep in mind the trader's mantra, volume precedes price. As such, volume will show changes in its characteristics that will alert traders to the end of an uptrend or a downtrend before the price actually reverses. For example, in a downtrending market, the volume should expand during the down move's confirmation of trend and contract during countertrend bounces. When the volume patterns begin to change, they serve to alert a trader to shifts in trend. Trends, and the strength of those trends, can be assessed and confirmed through the use of overlays to determine volume strength and the conviction behind price movement. Such overlays can confirm robust or lagging trends. Popular overlays include volume moving averages, linear regression, and moving average convergence divergence MACD of volume. Price formation patterns, when used in conjunction with their corresponding volume patterns, can also give strong confirmation as to the direction of a trade-worthy trend. Spotting the price patterns and corresponding volume patterns of pennants, flags, triangles, and gaps helps to predict a continuation in trend direction. Chapter 5. The Volume Alert, Identifying Trend Reversal Patterns. So far in our volume analysis, we have explored a variety of trading tools and methods to identify chart patterns and assess trends. A trend reversal pattern can occur intraday, lasting a few hours, short-term, lasting a few days to a few weeks, or long-term, lasting several months. The recognition of reversals is a critical skill in the trader's toolbox. It is typically easier to spot and follow trends, but also easier to get burned when a reversal signal is missed. A great degree of analysis and insight is required to spot reversal patterns, and the ability to do so can set you apart from the average trader. Chapter 5 focuses specifically on identifying trend reversal patterns. These chart patterns contain volume behavior that provides insight into the conviction of the trend, and can alert us to perhaps the most critically important patterns in the market for traders. In our volume analysis, we will examine examples of broad market trend reversals, index reversals, and the reversals of individual issues. We will look at longer-term macro trend reversals and shorter trend reversals, of interest only to an intraday trader. What to keep in mind when examining these charts is the trader's mantra, volume precedes price. The intensity of a reversal may come as a surprise, but the reversal itself never should. The market flashes warning signals, and the volume behavior within these patterns is an early alert that a change in sentiment and trend is underway. Macro, or longer-term, trend reversals. Using volume analysis, we identified the price trend and assessed under what circumstances we might anticipate a reversal. In this section, we focus our attention on actual trend reversal patterns. All the reversal patterns that we will be discussing can occur in the broad market, in an index or commodity, or in an individual issue. Our first three examples display simple trend reversal patterns in the macro, or longer-term, prevailing trend. Chart 5.1 for the iShares Russell 2000 Trust ETF IWM shows how the volume pattern tipped traders off that a change in price direction was coming in the summer of 2007. Price had been in an uptrend, a pattern of higher highs and higher lows since March 2003. The full trend duration is not shown in order to scale recent events properly. As price made new highs in May and June 2007, seen in Area A, the price pattern became choppy. Looking at price alone would tell you that IWM was in a consolidation phase, but that's about it. When volume is included in the analysis, however, the picture becomes clearer. Notice how volume activity increased during this choppy phase. Following a trend, choppy price action combined with an increase in volume is a sign of distribution. Every time eager buyers entered the market, there were sellers willing to take profits and give up their shares. The elevated supply held price in check, which prevented any further upward push in price. In Area B, the overhead supply proved too much for the market to bear, which prompted sharp selling into August. At that point, a trend reversal was definitely taking shape, but we needed one more piece of evidence before making that call. That piece of evidence was the behavior of volume on the next rally attempt in Area C. Note how, on the rally attempt following the August sell-off, the volume contracted as price moved higher and approached the summer 2007 highs. This was a definite sign that there was not enough fuel in the tank volume to push prices significantly higher, which opened the door for a sell-off, Area D. Notice the consistently higher level of volume during the sell-off as compared to the previous rally attempt in Area C. That showed a definite shift in trader sentiment, and that sellers were firmly in control. Just as a volume spike in a strong uptrend can alert traders that buying pressure has exhausted itself in the market, a spike in volume following a steep downtrend can also alert traders that sellers have exhausted themselves in a fit of panic selling. Note in Chart 5.2 for IBM that the volume pattern is rather consistent throughout the 3-month downtrend from December 2004 through April 2005. In mid-April, however, volume spiked higher as price dropped sharply to a new low. The sharp increase in volume showed that sellers wanted out so bad that they were willing to dump shares on the market in order to protect themselves from further losses. This type of seller behavior usually marks a low point in sentiment. Note also how price chopped sideways in a 3-month consolidation pattern before reversing and moving higher. Reversal off an intense downtrend. Intense downtrend reversals are characterized by falling prices with noticeably rising volume. While the previous example in IBM showed steady selling with a consistent volume pattern, the intense downtrend shows true and strong negative sentiment. Chart 5.3 for the S&P Industrial Select SPDR ETF XLI shows a new downtrend developing in May 2008. Note how volume increased throughout the sell-off as price was making a series of lower lows and highs. This type of intensity reflected increasing negative sentiment as traders looked to eliminate further loss. The consistently high volume in October and November 2008 confirmed that negative sentiment toward XLI was still very strong. After a brief rally from late November into early January 2009, price once again headed lower, this time making a new low. As the new low was made, notice how volume decreased as price pushed lower. This change in the volume pattern showed that negative sentiment was waning. This meant selling pressure had weakened, indicating that a trend change was imminent. Short-term reversals and overlays. In the previous 3 examples, we concentrated on long-term macro trend changes based on our volume analysis over a period of months. What about changes in volume patterns for the more active trader wishing to capitalize on short-term price movements? One solution lies in the use of volume overlays. In this section, we will concentrate on the use of volume moving averages, VMA, first introduced and explained in Chapter 4. Shorter period VMA parameters show changes in volume patterns useful for the active trader to spot short-term trends. The key to selecting the proper time frame for your VMA is to pick a length that is neither too short, which can lead to trading whipsaws, nor too long, which can lead to indicator lag, or the generation of late signals. In our volume analysis of short-term reversals, we chose a 9-period exponential moving average, EMA, to use with our daily charts. An EMA, which weights more recent data more heavily, is favored over a simple or linear moving average for this purpose because of its sensitivity to recent data, and thus its ability to reveal more recent volume shifts. When examining the behavior of the VMA, traders should note its dual ability to both confirm a trend and signal a potential reversal. In the following discussion, we note the volume pattern of the VMA under different market conditions. In an uptrending market, an increasing VMA confirms that trader sentiment is positive, as buying pressure forces prices higher. A VMA that peaks and begins to turn lower in an uptrending market signals that buying pressure has temporarily peaked, which provides an early alert to a pullback, or to a potential reversal in trend. In a declining market, a rising VMA indicates that trader sentiment is negative, since selling pressure drives price movement lower, confirming the downtrend. Once the VMA peaks and moves lower in a downtrending market, it signals that selling pressure has diminished, thus providing an early alert to a rally or potential reversal. Chart 5.4 for the S&P 500 SPDR ETF, SPY, shows how the 9-day VMA can be used to pinpoint short-term lows in the market. Note how each time the VMA peaked after moving higher, a short-term trading bottom was formed in the market. Chart 5.5 of the Nasdaq 100 Trust ETF QQQQ shows the 9-day exponential moving average at work there also. This overlay tends to show more bottoms than tops because of the more emotional nature of market participants' elevated volume during sell-offs. But notice in the QQQQ chart how the 9-day VMA caught a couple of swing highs in QQQQ in March and June 2009. Reversals signaled by MACD volume overlay. It's worth looking at the same chart of QQQQ using the same volume principle, only this time using the moving average convergence divergence MACD volume overlay. See chart 5.6. This is a more sensitive overlay, as it shows more frequent and more clearly defined peaks. Notice how each time the MACD of volume peaked well above the zero line and turned lower, price changed short-term direction. This alerted the active trader to short-term changes in direction, which could be used for taking profits or initiating new positions. Volume behavior in trend reversal patterns. Every trend reversal pattern requires some pattern of volume in its development. In volume analysis, we interpret this volume pattern to either confirm the reversal pattern or refute it. The identification of these patterns can help a trader who trades with the trend to lock in profits and step aside, while a short-term trader may choose to catch the reversal. Either way, the goal here is not to get caught in a reversal, and volume patterns give plenty of warning signals to avoid them. In this section, we will look at several widely identified reversal patterns. The wedge. A wedge is a chart pattern constructed by two converging lines connecting a series of price peaks resistance and price lows support. It is like a pennant or symmetrical triangle pattern discussed in Chapter 4, except that it usually occurs in a rising or falling, not a horizontal direction. The wedge reversal pattern is typically longer term in nature, lasting anywhere from 3 to 6 months. In order for a wedge pattern to be a valid reversal pattern, however, there must be a prior trend in place to reverse. There are two types of wedge patterns, rising and falling. Falling wedges. The falling wedge has bullish implications, as it normally breaks up out of the wedge to begin an uptrend. The boundary lines of this pattern converge, with each slanting downward as the pattern forms. Another characteristic of a falling wedge is that the upper boundary line, or resistance line, normally has a sharper slope than the lower boundary line or support line in the pattern. A flatter support line shows that selling pressure is diminishing, as sellers are unable to push the price down much farther with each new round of selling. Price should touch each line's support and resistance at least twice during the formation of the pattern. The more times the boundary lines are touched, the more reliable the pattern is thought to be. During the formation of the pattern, volume generally lightens as the wedge develops, showing a lack of conviction among both buyers and sellers. A buy signal is given when price breaks through the upper resistance line. The breakout should be confirmed by heavier volume, but price must also confirm the breakout by posting successive closes above the upper resistance line. Chart 5.7 for Starbucks, S-Bucks, shows how volume drops as the pattern is formed and then explodes on the bullish breakout, sending prices sharply higher. Rising wedges. A rising wedge has bearish implications, as price normally breaks out to the downside to resolve the pattern and begin a downtrend. Price movement contracts, i.e., narrows, as the pattern develops, showing that upside momentum is slowing. The top line resistance typically has a flatter slope than the bottom line as it pushes higher, showing diminishing buying pressure as the pattern progresses. A sell signal is given when price breaks below the support line. As with the falling wedge, the breakout should be confirmed by heavier volume. The breakout must also be confirmed by price posting 2 successive closes below the support line. Cisco Systems, CSCO, in Chart 5.8 shows the low volume pattern as the rising wedge forms, followed by the volume explosion on the downside breakout. The head and shoulders reversal pattern. The standard head and shoulders reversal pattern forms after an uptrend. It signals a bearish reversal. It consists of 3 peaks, with the middle peak, the head, being higher than the other 2, the shoulders. The shoulders are typically, but not always, equal in height. The reaction lows of the first 2 peaks, i.e., the left shoulder and the head, can be connected to form the neckline, or signal line. Chart 5.9 illustrates the pattern. The head and shoulders pattern signals a top, as the last bits of buying energy come into a stock or contract. The head is the final upsurge, with the right shoulder representing a smaller surge of late buyers coming to the party, only to be eventually disappointed. Buyers may make more than one weak attempt to push prices higher, as is described shortly. Volume plays a very important role in confirming the head and shoulders pattern as it develops. Volume should be lighter on the head than on the left shoulder, and volume should be lighter on the right shoulder than on the head. The most critical of the 3 peaks, however, is the right shoulder. Volume should contract noticeably, signaling that buying interest in the security is weakening, which indicates that a change in sentiment is underway. Volume should increase on the downside break of the neckline, showing that selling pressure is building. Following the neckline break, there is usually one more rally back up to the neckline, which should act as resistance. The rally to test the neckline should be on lighter volume than the downside break of the neckline. Prices should then roll over one more time on expanding volume to indicate that a new downtrend is underway. The chart of the Dow Jones Industrial Average Diamond Series Trust ETF DIA in Chart 5.10 shows a typical head and shoulders reversal pattern. Notice the distinct peaks at the top of the chart that form the left shoulder, head, and right shoulder. A head and shoulders reversal pattern is not readily apparent until the pattern corrects from the head and begins to form the right shoulder. At this point, the pattern should be watched, but nothing more. Notice that as the right shoulder formed, volume dropped, signifying that there was insufficient demand to push price back to the high, the head. As price pushed lower from the right shoulder, it broke down through the neckline as volume increased dramatically. This shows that sentiment had changed and that sellers were in control. Price then consolidated for 2 months before rallying up to test the neckline in March into May 2008. As price approached the neckline, volume decreased, confirming the negative sentiment. Once price touched the neckline and was unable to break through, volume picked up again as price resumed its downtrend. Calculating price targets with head and shoulders patterns, the head and shoulders reversal pattern allows accurate price targets to be generated. Price targets are computed by measuring the distance between the head and the neckline. That amount is projected lower from the point of penetration of the neckline after the right shoulder is formed. Projections from these formations can give a trader a price area to look for support and possible long entry, depending on other confirmatory indicators. Chart 5.11 shows the price target projection methodology. Using the DIA chart from Chart 5.12, we can examine the price projection that could be generated by the head and shoulders formation noted previously. The price calculation is as follows. 1. Project straight down from the high point of the head, $141.95, to the value of the neckline, $126.40, on that particular day. 2. Subtract the value of the neckline from the high, $141.95 minus $126.40, equals $15.55. 3. When the neckline is broken, after the right shoulder is formed, subtract $15.55 from the value of the neckline on the day it was broken. $128.15 minus $15.55 equals $112.60. Once the price target is reached, it is more of a signal to take profits on short positions than a blind buy signal for those looking to get long. Whenever looking to initiate a new position, always make sure that other indicators confirm the fact that a bottom may be in place. Notice how after a brief period of consolidation, the price for DIA turned lower yet again, as sentiment toward it remained negative. Inverse head and shoulders pattern. The inverse head and shoulders is a bullish pattern, essentially the upside-down version of the standard head and shoulders reversal pattern, and it is formed at price lows. It is just as reliable as the head and shoulders formations at highs, only the chart pattern is inverted. The same volume characteristics apply during the formation of the pattern, as it should be weakest at the formation of the right shoulder and explode higher on an upside break of the neckline. In Chart 5.13 for Amazon.com Amazon, notice how volume is subsequently weaker from the left shoulder to the head and from the head to the right shoulder. As price gaps up through the neckline, volume explodes higher, showing that sentiment is positive and a new uptrend is beginning. The inverse head and shoulders pattern projects price targets in the same manner as the head and shoulders reversal pattern at tops. 1. Projects straight up from the low of the head, $34.68, to the value of the neckline, $59.33 on that particular day. 2. Subtract the low from the value of the neckline, $59.33 minus $34.68 equals $24.65. 3. When the neckline is broken after the right shoulder is formed, add $24.65 to the value of the neckline on the day it was broken. $57.25 plus $24.65 equals $81.90. Candlestick reversal patterns. We introduced candlesticks as a popular charting tool in Chapter 4 and gave one example of a candlestick pattern that signaled trend continuation. Here we switch the subject to reversals, where several well-known candlestick patterns can play a valuable part in their identification. Spinning top reversal. A spinning top is a classic candlestick pattern showing trader indecision following an advance or a decline. The small real body shows little difference between the opening and closing prices, yet the long shadows show that there was considerable intraday action on the part of both buyers and sellers. The spinning top formation is a sign that sentiment may be changing, as the day's trading activity essentially ends in a stalemate. Volume can also give clues as to the validity of such patterns, showing the sentiment of traders. Chart 5.14 for Citigroup C shows two examples of spinning tops, one following an uptrend and one a downtrend. After the uptrend through late April, the spinning top, looking somewhat like an elongated plus sign, formed on very low volume, signifying that there was not much positive sentiment or buying power left to prolong the advance. Price reversed the next day, beginning a 6-week decline. At the end of the decline in mid-July, another spinning top formed. This time it was on a noticeable increase in volume, signifying that buyers were stepping up to meet the sellers and putting the brakes on the decline. The elevated volume with the spinning top pattern showed a short-term change in sentiment that led to a furious 6-day rally. As Chart 5.14 shows, it is the change in volume along with the shape of the candlestick and the prior price behavior that indicates a reversal. A weakening of volume indicates a weakening of the prevailing sentiment, while a significant strengthening shows a greater struggle emerging between buyers and sellers. Doji reversal. A doji is formed when the day's opening and closing prices are virtually equal, causing the real body to look like a dash or a straight line. A doji is like a spinning top, except with much shorter upper and lower legs, that is, much less intraday price fluctuation. It is also an indication of indecision, signaling that the forces behind the prevailing trend may be weakening. Lower volume on a doji is an indication that those who have wanted to participate in the trend have done so for the time being, while an increase in volume shows that there may be a struggle for near-term direction underway between buyers and sellers. In either case, a doji can represent a short-term change in sentiment and thus price direction. In Chart 5.15 for Freeport-McMoRan ran FCX, note how the doji formed after a move higher through virtually the entire month of November 2004. The two white candles before the doji occurred on decreasing volume. That was a sign of trouble. The formation of the doji on increasing volume was a sign that a reversal in this case, a correction, was near. Price reversed lower the very next day, leading to a decline of 17% over the next 7 trading days. This is a fairly basic doji reversal pattern, and there are many others beyond the scope of this book. Hammer reversal. A hammer is a bullish reversal pattern that forms after a decline. The pattern consists of a small real body at the top of the candle with a long shadow or tail, a bit like a piston in an automotive engine. The pattern shows that sellers drove the price lower earlier in the session, but then buyers saw value and came in to provide support to prices. This is a form of climax selling that is validated by heavy volume. The reversal is confirmed by either a gap up or a large white candle the following day on heavy volume. In Chart 5.16, the S&P 500 shows a classic bullish hammer reversal. Note how price had declined prior to the formation of the hammer, so there was prior negative price action to reverse. The day following the hammer formation was a large white candle bullish on even heavier volume, confirming the start of a new uptrend. Note that the same pattern inverted with an upside-down hammer indicates a bearish reversal. The long tail above the hammer body reflects a stronger buying interest that failed intraday, giving way to weakness to follow. To interpret such candlesticks, it also helps to look at intraday volume, that is, where the higher volume occurred on the formation of the tail on the way up or on the way down. Weak volume on the up leg with stronger volume on the downward intraday move, of course, would show weakness. Exhaustion gaps. A gap is caused by a break in the price pattern, or a blank spot on the chart where no trading occurs at specific price levels. Gaps most commonly occur on opening prices following a specific news event that causes a large number of either buy or sell orders to accumulate prior to the open. That accumulation causes a large adjustment in price relative to the prior close. We first described gaps in Chapter 4 in the context of continuation gaps. Here they come up again as part of a reversal pattern called an exhaustion gap. Exhaustion gaps occur following a strong move in the price of a security as demand overwhelms supply, or vice versa. The large gap in the direction of the trend along with a spike in volume suggests that trader conviction may have exhausted itself. While a gap higher on strong volume can look very bullish, and a gap lower on strong volume can look very bearish, recognizing these reversal patterns can help a trader lock in profits and preserve capital. Chart 5.17 for Citigroup shows an exhaustion gap on December 17, 2009, following a long downtrend. Notice how price gapped strongly to the downside on a huge spike in volume. That was a sign that the selling had reached a crescendo there, and that a bottom could be expected in that price area. Gaps are not always an indication of a quick tum in the other direction, but at the very least, there should be little or no pressure left to continue the previous trend. The continuation gap, see Chapter 4, occurs after a period of indecision. The exhaustion gap acts more like a crescendo at the end of a definable trend. Blow-off tops. Blow-off reversals are associated with tops and are similar in psychology to exhaustion gaps in that they occur at the end of trends and are characterized by one last thrust higher, giving a sharp peak on the price chart. Following the final thrust of an uptrend, price usually reverses sharply lower as all of the buying pressure has been exhausted during the final push into the high. That leaves a vacuum, which allows price to fall very rapidly as the profit takers and late buyers sell their shares. The weekly chart of silver in Chart 5.18 shows how the uptrend accelerated in early 2008. Notice how, as price reached what would turn out to be the top, volume accelerated very rapidly, signaling that a change in direction was imminent. Notice also the sharp reversal in price, which makes this a textbook example of a blow-off top. It is also possible to have blow-off bottoms, which are simply the inverse of the blow-off top pattern. Parabolas. Parabolas are reversal patterns showing a sharp acceleration in buying. They are most frequently associated with tops. The parabolic move begins with an acceleration that moves higher off an established trend line, often in a parabolic or curved fashion. As price accelerates higher, it no longer moves in a normal, linear uptrending manner. The advance takes on the shape of a curve or parabola. This pattern shows very strong, almost frenzied activity among buyers. Parabolas have a pronounced increase in volume as they come into the high, typically the highest point of volume for the move. If a trader stays too long, these patterns end badly, with sharp increases in volume as price falls rapidly. Chart 5.19 for the iShares Silver Trust ETF SLY is a classic example of how a parabolic move begins with an acceleration that launches off an established trend line. Once the move is complete on the highest volume to date for the move, SLY reverses sharply on even larger volume, signaling that the up move is definitely over. Double and triple reversals. We conclude this chapter with a description of double and triple reversals, a commonly used set of patterns indicating exhaustion prior to reversal after a long uptrend or downtrend. Double bottom reversal. A double bottom reversal is a pattern formed off of a long uptrend. The pattern consists of two consecutive lows at relatively the same level with a moderate swing peak formed in between them. It signifies that selling has run its course for the trend, and that trader sentiment is changing. The pattern takes the shape of a W, with volume typically lower on the second low point than on the first. Double bottoms are typically a long-term signal. That is, they occur over the course of several days or even weeks. Chart 5.20 for Hewlett-Packard HPQ shows how a double bottom is formed. Price had been in a prolonged downtrend prior to the formation of the double bottom in the summer and fall of 2002. The double bottom reversal developed as follows. 1. Price came down and made a new low at point A, which was the first line in the W pattern. 2. Price then rallied to set a moderately higher peak at point B, which formed the next line in the W pattern. 3. Following the peak at point B, price went back down to a point very similar to the first low, point C, which formed the third line of the W. Notice how volume coming into the low at point C was very light as compared to the low at point A. 4. Price then moved higher from the low at point C on accelerating volume, indicating a change in sentiment and forming the final line in the W pattern. 5. The reversal and a new uptrend were not confirmed until price moved above resistance at point B. After price moved above point B, long trades should have been considered. Double top reversal. A double top reversal is the opposite of a double bottom. It is formed following a long uptrend and consists of two consecutive highs at relatively the same level, with a moderate swing low formed in between. It signifies that demand for the stock or contract is weakening, which leaves the door open for a change in direction as sentiment is changing. This pattern takes the shape of an M, with volume typically lower on the second high. Generally, this also is a long-term signal. We'll use Hewlett-Packard as an example again. Chart 5.21 shows how a double top is formed. Price had been in a prolonged uptrend prior to the formation of the double top in the summer and fall of 2002. The double top reversal developed as follows. 1. Price made a new high at point A, which was the first line in the M pattern. 2. Price then declined to set a moderately lower trough at point B, which formed the next line in the M pattern. 3. Following the low at point B, price went back up to a point similar to the first high, point C, forming the third line of the M. Notice how volume coming into the high at point C was very light as compared to the high at point A. 4. Price then moved lower from the low at point C on accelerating volume, indicating a change in sentiment, which formed the final line in the M pattern. 5. The reversal and a new downtrend were not confirmed until price moved below support at point B. After price moved below point B, long trades should have been exited and short trades could have been considered. Triple top reversal. The triple top reversal pattern consists of 3 peaks at relatively the same price level with 2 intervening swing lows, or troughs. The pattern is resolved by breaking down through the support line drawn connecting the 2 trough points in the pattern. As with the double top pattern, volume plays a key role in both identifying the pattern and then confirming the reversal in the triple top. The triple top is, of course, similar to the double top, except that the confirming breakthrough support doesn't occur until after the third top. Oracle in chart 5.22 shows how a triple top is formed. Price had been in a prolonged uptrend prior to late 2007 when this chart begins. The triple top reversal formed as follows. 1. Price made a new high at point A. 2. Price then declined down to point B. At the time, this looked like nothing more than a normal swing low in an uptrend. 3. Price then moved higher to a price almost equal to point A. This formed point C. At point C, this could have been a double top in the process of forming. But remember, the swing low at point B would have to be taken out to confirm a reversal. 4. Price then declined to point D, which was higher than point B, so no reversal signal was given. 5. Price rallied and stopped at point E, which was virtually equal to point CAT, the $23.50 level. Notice how, at point E, volume contracted after price hit resistance at $23.50. That showed a lack of demand at that level, which indicated that a change in sentiment was beginning to take hold as the third attempt to get through $23.50 was faltering. 6. Price declined from the high at point E on accelerating volume. 7. Price broke through the support line point B to point D on increasing volume, which confirmed the reversal in sentiment and trend. It should be obvious that if the double top reversal isn't confirmed in a chart, there is still a chance for a triple top, and it should continue to be tracked for such. Again, the key is to watch price and volume behavior as the price approaches the support level. Triple bottom reversal. The triple bottom reversal pattern consists of 3 lows or troughs at relatively the same price level, with 2 intervening swing highs or peaks. The pattern is resolved by breaking up through the resistance line drawn connecting the 2 high points in the pattern. As with the double bottom pattern, volume plays a key role in both identifying the pattern and confirming the reversal. Chart 5.23 for Yahoo. Yahoo shows how a triple bottom is formed. Price had been in a prolonged downtrend prior to the formation of the pattern. The triple bottom reversal formed as follows. 1. Price hit a low at point A. This low actually consists of 2 points, the first high volume push down and then the low volume drift back down to the low area once emotions settled down. 2. Price then advanced up to point B. Volume on the advance was weak, signaling that investor sentiment had not yet changed. 3. Price then moved lower to a price almost equal to point A. This formed point C, which could be the second low in a double bottom, but that it was the second low could not be verified unless price broke through the high at point B. 4. Price then advanced to point D, which was lower than point B, so no double bottom reversal signal was given. 5. Price declined and stopped at point E, which was virtually equal to point C. Notice how volume contracted to almost nothing at point E. That showed a lack of supply at that level, which indicated that a change in sentiment was beginning to take hold as the third trip down to the low area was faltering. 6. Price advanced from the low at point E on accelerating volume. 7. Price broke through the resistance line B to D as volume exploded, confirming the reversal in sentiment and trend. Summary. A combination of price and volume patterns can signal and confirm a trend reversal, whether they occur in the broad market or in an individual security, and whether they be longer-term macro or shorter-term. Throughout our volume analysis of these reversal patterns, the trader's mantra continues to hold true: volume precedes price. Important reversal patterns include wedges, head and shoulders, certain candlestick patterns, double and triple tops and bottoms, exhaustion gaps, blow-off tops, and parabolas. A trader should recognize the pattern and confirm it with volume behavior. Every technical price reversal pattern has a volume pattern component. This volume component can be used to verify a trader's translation of the reversal pattern. In the absence of volume pattern confirmation, a trader's translation of a trend reversal pattern should be questioned. Chapter 6. News, Noise, and Volume. The central theme of our volume analysis thus far has been to identify how volume affects price trends and reversals. In this chapter, we dial in to how external events, including news items, market events, time factors, and the seasonal characteristics of markets themselves, can influence volume patterns. We also seek to distinguish the normal and anticipated fluctuations in volume patterns, noise, from meaningful changes in volume patterns that signal a shift in trend direction. We'll start by describing the effects of news, both external news that is relevant to the business, financial, or political climate in general, and internal news, or news that is pertinent to the company or particular security in mind. We'll continue with a description of other time and event-related factors that affect volume, including options expiration, dividend payments, and seasonality. Finally, we'll touch on the latest phenomenon affecting market volume and liquidity. But, to the surprise of many, in our view, it doesn't significantly affect volume patterns or trend direction. That is, the advent and growth of computer-driven high-frequency trading. Read all about it. How news affects volume and trading. The market price for an equity, bond, index, or commodity is affected by a constant flow of external and internal news and data. Whether it is company earnings, crop reports, a change in corporate structure, or any other piece of news, traders are constantly adjusting their opinion of fair market value. The important thing to remember is this: the impact of any given news event or corporate announcement is reflected in volume. In many cases, volume spikes occur at these important junctures because of the availability of news to all market participants simultaneously. A volume spike is best defined as a sudden, dramatic increase in volume from one trading day to the next. Volume spikes have become more prevalent recently for two main reasons. 1. The SEC enforcement of Regulation FD on October 23, 2000. 2. The advent and development of the Internet and electronic news media. Regulation FD, fair disclosure, was introduced to level the playing field with regard to dissemination of pertinent company information and its availability to individual investors. It states that firms must disclose all relevant information to everyone at once and without delay, whether that information is favorable or unfavorable. The introduction of Regulation FD came about to alleviate concerns surrounding the fact that individual investors did not receive corporate disclosures as quickly as brokers, major market players, and large institutional clients. Regulation FD attempts to eliminate the advantage enjoyed by the better-connected players, who could use early releases of information to front-run expected reactions by the crowd. The regulation and its intents were aimed more at internal information gathered by brokers and fund managers in direct conversations with companies, such as their outlook on earnings, or even hints as to good or bad future expectations. The effect of Regulation FD has been to suppress conversations on many topics that once were discussed in meetings between major Wall Street players and company management. Passage of the regulation has led to a more uniform reporting procedure, which limits the ability of brokers and money managers to receive pertinent information ahead of the general investing public. The net effect of this regulation has been to create huge spikes in market activity surrounding newsworthy events, as all market participants receive and act on the same piece of information simultaneously. Regulation FD was developed with the Internet in mind. The advent and development of the Internet has provided the perfect conduit for the distribution of company news releases. In contrast, in years past, analyst reports were mailed to clients, who may have taken their time reading and acting on the reports. Also, for most traders, stock prices were not readily available until either a late evening or early morning edition of the local newspaper. Now there are countless news sites and organizations that are capable of relaying company news. The ability of cell phones to receive email, tweets, brokerage alerts, and the like contributes to a massive, instantaneous, and simultaneous flow of information that can cause thousands, if not millions, of traders to input their orders at once. Regulation FD makes sure that companies do not pre-release any important information to specific individuals, but when the information is released according to Regulation FD guidelines, the effect is an almost instantaneous spike in volume. The following items can cause volume spikes: earnings announcements and company conference calls, revised earnings outlooks, analyst upgrades and downgrades, mergers and acquisitions, changes in company leadership, legal action and settlements, news of a product defect or liability issue, injuries, recalls, etc., failure or success of a developmental drug in trial stages, granting or denial of approval by the U.S. Food and Drug Administration (FDA), market-wide phenomena such as elections, interest rate adjustments, and geopolitical events. Most of the previous examples apply to individual stocks, bonds, and indexes, but macroeconomic events have equally far-reaching effects on worldwide markets, such as the currency, commodities, and interest rate markets. For example, crop and commodity supply-demand reports and geopolitical events can have enormous impact on commodity prices and currency markets. Earnings announcements. Traders understand that the price of a given stock reflects the sum of all knowledge regarding that stock at a given time. Applying this principle, quarterly earnings announcements provide a perfect opportunity to surprise traders or provide a catalyst for a move to sharply higher or lower prices. The presence of a volume spike provides confirmation that the conviction of the masses has decided that price must move higher or lower to reflect the newly released information. On April 15, 2010, Google announced earnings that easily beat Wall Street expectations. However, once the news was digested, there were two perceived problems with the announcement. First, traders had become accustomed to Google beating earnings estimates by a wider margin. Second, there was a simmering dispute with China that threatened to reduce Google's exposure and market presence in that country. Those two pieces of information caused trading sentiment to change quickly, leading to an increase in selling pressure. Google's share price moved lower on a large volume spike. In Chart 6.1, for Google Goog, note first a fairly common volume pattern in which volume tends to dry up in the weeks prior to an earnings release. As is typical with such a pattern, volume picked up a few days ahead of the announcement as traders either exited because of uncertainty or entered new positions in optimistic anticipation of the release. During the day following the announcement, volume spiked, revealing that the report had been poorly received and leading to a change in trader sentiment. Earnings announcements do not always cause a change in price direction. Chart 6.2 for Apple Inc. MPL shows volume spiking intraday as buyers and sellers wrestled for control over price direction, but at the end of the day, sentiment remained close to where it had been prior to the announcement. Unlike the Google example in Chart 6.1, where there was a clear change in sentiment, the Apple Inc. earnings announcements validated the current market sentiment toward the company. As a result, the price trend continued in the direction and pattern exhibited prior to the announcement. Note again how volume began to increase prior to the announcement. Since earnings were released after hours, price reactions occurred on the next trading day. Notice that the far right-hand side of Chart 6.2, following the April 21, 2010 price reaction, exhibited a brutal sell-off. That was in reaction to external news, the European debt crisis, which affected the market as a whole. Worldwide or macro events can affect stocks as a group and supersede any company-specific information. Volume plays an important role in identifying these situations as well. Market-wide events. The types of news events mentioned previously often cause volume spikes and sentiment changes for individual equities. Most of these events are internal, that is, about and generally initiated by the company. External market-wide events that cause volume spikes and surges typically take weeks, and in some cases months to unfold before sentiment culminates in a change in price and trend direction. One of the best examples of volume spikes culminating in dramatic shifts in trader sentiment can be seen during the Russian financial crisis and the subsequent long-term capital management bailout in the fall of 1998. The Russian financial crisis, also called the ruble crisis, followed on the heels of the Asian financial crisis, which started in July 1997. Both were related to declining commodity prices. Decline in productivity, fiscal deficits, and a high fixed exchange rate of the ruble led to the meltdown. The Russian financial crisis first became evident in the news as early as May 1998, but its effects were not felt in U.S. markets until July of that year. It was only at that point that traders became concerned that it could mushroom into a worldwide economic event. On top of the potential Russian debt default, a major U.S. hedge fund, Long-Term Capital Management, LTCM, had significant exposure to Russian assets and was suffering heavy losses. LTCM's failure led to a coordinated and substantial bailout of banks and investment firms by the Federal Reserve. The markets plunged in early September 1998, rallied briefly, then plunged again in early October despite a government bailout of LTCM. Traders continued to panic that not enough was being done to avert a global financial crisis. Each plunge lower in the early fall was accompanied by sharp increases in volume. 1 week after the October low, the Fed announced its second rate cut in 2 weeks. That in turn helped the equity market to recover and begin the journey up to the 2000 highs. Chart 6.3 shows the strong and emotionally driven volume spikes and selling. Note the double bottom price pattern, see Chapter 5, generated on large, emotion-driven volume spikes. Once the selling pressure eased, the markets were in a good position to rebound in the absence of further bad news, calendar and time-driven events. Time-dependent fluctuations in volume play a role in shaping volume behavior and volume patterns over a day, a week, a month, or a year. Failure to understand these time-dependent volume patterns can expose you to poor decisions in response to perceived changes in volume, driven less by buying and selling pressure than simply by the timing of their occurrence. Such calendar and time-dependent normal volume patterns include options expiration, intraday volume, the pattern of volume through the course of an ordinary trading day, dividend payment schedules, and normal seasonality patterns. Options expiration. An option contract is a derivative, meaning that its value is derived from the value of an underlying asset. Option contracts exist for futures contracts, commodities, stocks, stock indexes, bonds, and interest rates, among others. Options expiration is a day when the holders of option contracts must either exercise them, that is, initiate a transaction to acquire or dispose of the underlying security, or let them expire worthless. Options expiration occurs on different days in different markets. The best known and most reported expiration dates occur monthly, triple witching expirations, which are related to options on individual stocks, index futures, and stock indexes expiring concurrently. Quarterly expirations, or quadruple witching expirations, occur with the concurrent expiration of options on individual stocks, index futures, stock indexes, and single stock futures. Both occur on the third Friday of the month. There is typically, but not always, a noticeable rise in volume on these days, depending on what security or index is examined. Expiration days that produce very heavy volume may not necessarily be meaningful as far as trend or even supply-demand analysis is concerned. On these days, there are many crosscurrents flowing beneath the market as traders exercise their contracts to fulfill contractual obligations, which tends to add noise to meaningful volume analysis. In Chart 6.4, showing the E-mini S&P 500 futures, the options expiration dates for the first 5 months of 2010 are marked. Notice how expiration days on higher volume did not translate into any appreciable change in trend direction. Next is a look at the S&P 500 cash index. See Chart 6.5, the most widely quoted benchmark for equity or broader stock market performance. The same pattern appears in the broader market. Notice how, in both charts 6.4 and 6.5, the higher volume totals in the March and April expirations did not lead to immediate trend changes. In fact, the strength of the March trend continued following the March expiration. A case could be made for April, however, as the price trend reversed and headed lower 2 weeks later. At best, the increase in volume could be described as the beginning of a 2-week distribution pattern. Notice that more higher volume days were seen on pullbacks than on advances. Intraday volume patterns. Optimum liquidity. Markets tend to exhibit increased volume near the open and often at the end of the market day, in the 2 hours prior to the close. Intraday volume patterns are predictable. They typically show a U-shaped structure, with higher volume totals coming at the open and the close, while volume slows dramatically at midday, typically 11 a.m. to 2 p.m. U.S. Eastern Time for equities. Volume is typically higher at the open as traders, managers, and institutions place their buy, sell, and market orders. Traders have had 17.5 hours from the market close to digest the previous day's market activity and prepare to enter their trades. They have an even longer period of time from a Friday close to a Monday open. Trading volume is also higher at the end of the day, as traders who trade only during open market hours, day traders, square up their positions before the market close. Optimum liquidity, or tighter bid-ask, spreads typically occur within 90 minutes of the open and 2 hours before the close, as volume steadily increases after 2 p.m. Eastern Time. The 15-minute chart of SPY, chart 6.6, showing the volume patterns of June 7 and 8, 2010, is typical of the daily volume pattern in equities. The normal intraday volume patterns in chart 6.6 reveal when the most liquid times of day occur for the most favorable bid-ask spreads. Midday news events can disrupt these normal volume trading patterns and cause volume spikes, such as in our Federal Reserve Fed policy announcement example. Chart 6.7, which shows a 15-minute interval chart of SPY on March 15 and 16, 2010. The Fed statement came out at 2:15 p.m. Eastern Time on March 16. Notice how price movement, volatility, contracted sharply with volume during the middle of the trading session on both days, but even more so on March 16, just before the announcement. At 2 p.m., traders started wading into the market to take up positions in anticipation of the announcement. Note how volume and price volatility both explode higher following the announcement. The price bars grow as many more traders enter the market, causing wider price swings. Now, if we step back and examine how March 16, 2010, looked in a normal daily time frame, 1 bar per day, we can see that the intraday explosion of volume was really a non-event, just an intraday distortion of an otherwise normal daily volume level. In chart 6.8, note how low the volume total was for March 16, and that the upward swing experienced by the market lasted for only a day before retracting. This example displays the importance of choosing your trading time frame correctly. The rally following the Fed announcement on March 16 and into March 17 might signal a nice uptrend for an intraday or swing trader, while the reaction following the Fed announcement would be nothing more than noise to a longer time frame position trader. Dividends and ex-dividend dates. The topic of dividends is more complex than simply buying a stock and collecting the dividend. While many trading strategies include dividend-paying stocks to generate income, traders and managers must also factor in the tax consequences of those strategies. This can create buy, sell, and hold trading activity around ex-dividend dates. The many decision points made around these key dates can cause slight increases in volume behavior. Again, this volume action is not necessarily related to trader sentiment toward a particular stock or ETF, but rather to the tax implications of a trader or manager's actions. The ex-dividend dates, that is, the dates of share ownership for dividend eligibility of stocks, are published in advance. This allows for planning by those who trade around the payout date. The price of the stock is adjusted to remove the dividend so that traders cannot simply buy the shares, collect the dividend, and sell the stock. Ex-dividend dates allow those planning to purchase a stock to wait until after the dividend is paid to avoid the taxable event of the dividend payout. While these strategies are valid and are used, we note that their execution has little effect on price trend movements outside of the normal flow of orders throughout the trading day. The example of 3M Company, MMM, in Chart 6.9 shows that planned quarterly dividend payouts do not create much in the way of abnormal trading activity or volume levels. This is the case with just about any dividend-paying stock that pays on a regularly scheduled basis. There are times, however, when special dividends can create quite a stir. The example of Scott's Miracle-Gro, SMC. See Chart 6.10 shows the contrast between a known dividend event of $0 and 125 cents per share on February 6, 2007, and a one-time dividend payout of $8.00 per share announced on February 16, 2007, with an ex-dividend date of February 22, 2007. Chart 6.10 shows how volume action surrounding a quarterly scheduled dividend payout is typically non-eventful as compared to a special dividend payment. On February 6, 2007, while some traders collected their dividends and exited their positions, other traders interested in avoiding the dividend tax waited on the sidelines for entry, as demonstrated by average volume totals for the stock. On February 16, Scott's Miracle-Gro announced a special one-time dividend of $8 per share to accomplish a financial restructuring. Note how buyers rushed in on February 20 to take advantage of the one-time payout. Then on February 21, volume remained above normal as others locked in profits from the run-up on February 20. Volume remained elevated for the next week, as those who purchased shares strictly for the dividend exited their positions while those who waited to avoid the dividend payout purchased new positions. Although substantial volume effects resulted from this rather unusual occurrence, dividends and dividend timing are usually noise in the market so far as volume is concerned. But for savvy traders, they are still worth observing. Seasonal volume. While volume can be affected at any time by news and world events throughout the year, broader market volume tends to show predictable seasonal and holiday patterns. Factoring these patterns into volume analysis allows a trader to identify when the broad market will be more heavily traded and anticipate normally lighter volume periods. Sell in May and go away has become a truism in the marketplace, as history points to the likelihood that trading markets tend to decline between May and mid-September. This tends to lead to lower volume during the summer months. Following Labor Day, positive seasonality begins to return, with volume increases in early fall. The increased volume pattern usually carries through until the following May. Volume also tends to decline just prior to long holiday weekends. Pick your holiday: Memorial Day, the 4th of July, Easter, Thanksgiving, Christmas, President's Day, or Labor Day. The light volume pattern is generally the same. However, lower volume does not necessarily equate to lower market volatility. In fact, because of lower volume, the markets are more thinly traded, and buy or sell orders can translate into disproportionately greater movements in both the up and down directions. During these holiday periods, we also see price action tending to follow a choppy, range-bound pattern as the lighter volumes lack sufficient energy to push prices in one direction or the other. Chart 6.11 shows the S&P 500 for years 2007 and 2008. Volume is plotted with its 20-day volume moving average, VMA, to make it easier to spot times when volume contracts below normal levels. Note how late August and mid to late December show declining volume with little price movement. Once these low volume time frames pass, the previous trend usually resumes. Does high-frequency trading affect volume analysis? In part as a result of the so-called flash crash of May 6, 2010, high-frequency trading, HFT, has become mainstream news. The flash crash refers to the intraday sell-off that drove the Dow Industrials down as much as 1,000 points before it recovered to 300 points. Human error and computer-generated trades have been the scapegoats to date. Although this phenomenon of extremely rapid computerized trading strategies has gone on for as many as 10 years, it has come to account for a vastly larger portion of overall stock market activity in the past 2 to 3 years. By many accounts, it makes up as much as 75% of all trading on certain high-profile, large-cap stocks, although only a handful of trading firms actually engage in it. What is HFT? It is a set of trading strategies, mostly undertaken by large Wall Street firms and a few specialized hedge funds with access to the right technologies, to buy and sell in very rapid trades to capture very small price increments on each trade. Trading time intervals are measured in microseconds. Trading increments can be fractions of pennies. The overall strategy is to capture as many small price increments as possible repeatedly throughout the trading clay, and in some strategies, to front-run larger orders before other players can act. Often this is done through sheer physical proximity to the exchange floors. The New York Stock Exchange, NYSE, has created special leased spaces next to its own computers for trading firms to locate their servers, shaving tiny increments off the physical speed of connectivity to the exchange. The technical details and specific strategies of HFT are beyond the scope of this book, but the obvious question is, what effect does HFT have on volume? And since our technical models are based on volume, doesn't HFT disrupt the very foundation of volume analysis? These are questions we've pondered and tested for some time. One issue, of course, is whether the incremental volume generated by computers flinging orders rapid fire back and forth with each other truly represents supply and demand, which is, of course, the pressure behind the volume we look for. The answer is probably not. Much of this activity is just what it is: trades going back and forth throughout the day. So does that actually distort our models? At this point in time, through back testing and observation of the effects of increased volume, we think the answer is no. Sure, volumes have increased dramatically in the past few years. But our observations are, for the most part, that the volume increase is simply scalar. That is, volumes have increased, but the underlying behavior of volume and the interpretation of volume shifts has not. Although so-called quote stuffing, placing unusually large numbers of electronic orders to buy or sell stocks and then canceling them, can have an effect on intraday pricing, we believe volume analysis may actually reveal these marketplace shenanigans. We see higher daily volumes and larger spikes in some cases, as occurred during the flash crash, but overall volume patterns have not changed in such a way as to negate the volume indicators and oscillators you will read about in upcoming chapters. One side note: high-frequency trading is often confused with so-called algorithmic trading, where large institutional orders are systematically taken apart into smaller increments to hide their size in the market. Currently, the SEC is exploring one such type of order that is placed in increments as small as 1/10 of a cent and at a distance from the actual price. This type of sub-penny pricing may be used to make it appear that more volume actually exists and that demand is actually elevated, thus benefiting sellers. Such order partitioning spreads demand and supply throughout the day, which has had an effect on some of the oscillators mentioned in Chapter 10 that depend on intraday volume. For the most part, however, our volume analysis already takes such patterns into account. As a result, at the time of this writing, we do not believe traders using volume analysis should be overly concerned about high-frequency trading. Summary: volume and volume patterns can be affected by an assortment of factors. They can be market intrinsic factors like options expirations, ex-dividend dates, and even time of day within the trading day. They can be exogenous factors like scheduled and unscheduled company news releases, earnings announcements, and so forth. These news and noise items can have varying influences on trading patterns, depending on the normal volume and pattern of the market or security being traded. Traders should understand these influences and take them into account when charting or modeling any given security. Thus far, So-called high-frequency trading influences total volume but not volume patterns in a way sufficient to change volume models. This assessment bears watching in the future, however. Chapter 7. Trading Time Frames and Indicator Selection. Up to this point in our volume analysis, we have developed our ability to recognize technical volume trends and technical volume price patterns with the help of volume overlays. We have explored the charts of simple and complex trading environments and provided some basic illustrations of how volume plays into the analysis of trend continuation, reversal, and sideways patterns. Now, we shift our attention to how best to use volume analysis to navigate the trading terrain. In order to navigate successfully, a trader is faced with several strategic choices. One of the most critical, in our view, is which volume indicators and oscillators should I select to best support my trading time frame? This chapter examines the parameters a trader should consider in making this decision, provides a detailed explanation of the nature of indicators and oscillators and the combinations thereof, and offers guidance in the process of indicator selection. Trading time frames and signal frequency. It's worth our noting briefly that the selection of a trading time frame will determine, to a greater or lesser degree, the number of trading signals generated, interpreted, and acted upon over a given time period. The best way to illustrate this signal frequency is by example. A trader working within 5-minute time frames will have to deal with many more signals in a trading day than someone trading in daily or weekly time frames. Trading in shorter time frames is a demanding and more time-intensive approach, while longer time frame traders generally have fewer and less frequent signals to interpret. Although a longer time frame may appear simpler, trading off fewer signals has its own inherent risks. Often, a shorter time frame with increased signal frequency can yield more trading opportunities. Selecting volume indicators and oscillators for your volume analysis. As every trader knows, the selection of trading tools can feel overwhelming. There are dozens, perhaps hundreds, of technical tools to choose from. The indicators we have chosen to discuss are those that can supply an additional volume dimension to your trading strategy. Although there is no such thing as one size fits all in trading, we do have some parameters that can help in navigating the volume terrain. Indicators perform differently under different trading conditions, so seek to utilize a volume component that will be versatile and provide signals to complement your existing strategy. Consider including the following in your volume analysis. A bar plot of volume so that you can quickly refer to current volume patterns. As price is inextricably tied to volume, every technical price charting formation will have a confirming volume pattern. A VMA or other volume overlay to act as a leading or confirmatory indicator. Use settings that complement your trading time frame. Depending upon your VMA time setting and its sensitivity to change points, the VMA will provide you the conviction behind the price trend, tops and bottoms, and turning points. A macro, or longer-term, indicator to identify the direction of the prevailing trend. Trades in the direction of the larger degree trend have a higher chance of success. One such indicator is on-balance volume, which gives a trader a good read on the longer trend and provides a basic framework from which trades in the direction of the trend can be favored. A volume indicator or oscillator complementary to your trading time frame. Having both volume and price-based components, these tools are able to identify not only the direction of the prevailing trend, but the conviction as well. When using and combining indicators, it is wise not to combine indicators that are redundant or that measure and display the same technical patterns. Longer-term versus mid to short-term volume indicators and oscillators. The volume indicators and oscillators listed here are discussed in more depth in chapters 8, 9, and 10. We've placed these technical tools in their most user-friendly time frames. As such, these placements are intended to act only as preliminary guidance. Longer time frame volume indicators. The following indicators and oscillators work best at displaying a more accurate picture of the longer-term or prevailing trend. Longer time frame indicators generate fewer trading signals. Please note that all of these are examined in more detail in Part 2. Accumulation distribution. Cumulative volume index, broad market indicator. L-intraday intensity. Negative volume index, on balance volume. Positive volume index. Volume accumulation oscillator. Volume price trend. Volume moving average settings, 60 days or longer. Mid to short time frame volume indicators. This set of indicators works best at detecting shifts in price and/or volume momentum over a short to intermediate time frame. Mid and short time frame indicators generate more frequent buy-sell signals, depending upon the sensitivity of their settings. 10-day open arms broad market indicator. 30-day open arms broad market indicator. Chaikin advanced decline oscillator. Chaikin money flow. Demand index. Ease of movement. Force index. Money flow index. 10-day up-down volume oscillator broad market indicator. Arms index broad market indicator. Volume oscillator. Volume rate of change. Leibovit volume reversal. Volume moving average settings short up to 5 days. Mid 5 to 60 days. Broad market or individual security indicator. The indicators mentioned previously that are marked broad market indicator use price and volume data from the major exchanges. These are required for broader market analysis and may not be suited to analyzing an individual security. However, if that security does track equivalently with a broad market indicator, then these tools can be used. Doing a simple price overlay of the security against the broad market indicator will answer this question. Any of the other indicators oscillators listed previously, however, could be applied directly to an equity, index, or commodity, if so desired. Indicators versus oscillators. Volume analysis provides traders with visual tactics to discern trends and patterns. Our charts contain volume indicators and oscillators designed to represent variations on the volume-price relationship. These mathematical formulas, which include volume, may reflect these aspects of price and volume in various weightings, as a single variable or set of numbers. When charted, these formulations can help spot trend strength, divergences, reversals, and other useful characteristics of price and volume over a given time period. As you read more about these trading tools, you'll soon discover that they fall into two categories: indicators and oscillators. Most traders will deploy an assortment of indicators and oscillators to fit their particular market and trading style. One way to understand indicators and oscillators is to understand the difference between the two. Indicators. A technical trading indicator is derived by applying a formula to a series of data points of price and/or volume. This produces a series of resulting calculated values that are usually graphically shown above or below the price chart. Creating a series of calculations and plotting them over time allows for analysis of where today's value is in relation to past values. Volume indicators are used to provide an extra level of analysis in addition to simple price and volume action alone. This type of analysis is used to either confirm a trend or show where the price trend may be ready to change, i.e., a divergence. Indicators often provide buy and sell signals based on their patterns. It is important, however, to use a weight of the evidence approach by confirming indicator signals with price and volume patterns to validate that signal. For example, it is normally unwise to execute a sell signal flashed by an indicator without confirmation when the behavior patterns of both price and volume indicate that a robust uptrend is in place. Oscillators. An oscillator is a technical tool that applies a formula to a series of data points that move above and below a center line or between upper and lower boundary levels on a set scale as its value changes with each time period. Oscillators are most commonly used to track momentum, the rate at which price or volume rises or falls. As price or volume rises in a healthy uptrend, momentum also increases. If price or volume continues to rise, but at a slower rate, then momentum will not keep pace, showing a divergence in the oscillator. A divergence shows that a trend is weakening and may be ready for a reversal. Oscillators come in two types. Banded oscillators use overbought readings in a downtrend or oversold readings in an uptrend, which can provide great trade setups. Centered oscillators can show extreme readings above or below the center line, but they are not best suited for that purpose. Chart 7.1, the daily record of the Nasdaq 100 Trust ETF QQQQ, shows the Money Flow Index, MFI, which is further defined in Chapter 10 as an example of a banded oscillator. You can see one of the drawbacks of using a banded oscillator in a trending market. Notice how the MFI did not reach the oversold zone, a reading below 20, during the 2009 bottom, and for the entire uptrend. It is important to know the characteristics of any indicator that you use and how it behaves in trending and non-trending markets. As with any indicator or indicator combination, select the ones you find most user-friendly and learn how they work both independently and together. Chart 7.2 shows the demand index as an example of a centered oscillator using zero-line crossovers to generate buy and sell signals. Crosses above the zero line from below are buy signals, while crosses down below the zero line from above are sell signals. Oscillators as predictive tools. One of the main concepts behind the use of oscillators is their ability to show divergences, or a weakening of the current price trend, which some say makes them leading indicators. There really is no such thing as a leading indicator, only a leading technical pattern, since all indicators are constructed using past data. Divergences reveal that a trend is weakening, but such divergences can last for weeks. This means that exiting a trade prematurely merely on the existence of a divergence can cost a trader much in the way of profits. There are two types of divergences. A positive divergence occurs when price makes a new low but the oscillator does not, while a negative divergence occurs when price makes a new high but the oscillator does not. In either case, the divergence is viewed as a non-confirmation of price action, which serves as a warning that a change in trend direction may be near. But traders shouldn't stop their volume analysis at this point. Trading divergences should always include some form of confirmation by at least one additional source before making a trade. For example, a divergence shown by the Money Flow Index would need confirmation from a separate indicator, such as the Leibovit volume reversal. For more on this specific indicator, see Chapter 9. The example of the US dollar index in Chart 7.3 shows how the MFI was showing a clear negative divergence as price made new highs. Naturally, such a divergence calls into question whether an aggressive trader should go short or take profits on the long side. As discussed previously, when a divergence occurs, it is unwise to exit prematurely or jump in with a position against the trend, as divergences can last for days or even weeks. This example also shows the use of a second indicator to confirm the divergence. In this case, it is a volume indicator, the 9-day volume moving average VMA plotted at the bottom of the chart. The Leibovit VR is a very good indicator for showing when control of the market is shifting from sellers to buyers, or in this case, from buyers to sellers. Notice in Chart 7.3 how the VR pinpointed the best time to act on the negative divergence in the MFI, using oscillators with other indicators. Oscillators are most effective when used in conjunction with other volume analysis methods, such as overlays and volume patterns, to determine support resistance, trend lines, and so forth. It always helps to look at oscillator signals in the proper context as they relate to other methods of analysis. One of the drawbacks of oscillators is that they can give false or whipsaw signals. That is another reason to use oscillators with other trading tools. Doing so helps reduce the number of false signals that may be generated, matching volume indicators and oscillators with market conditions. Often a trader must choose the trading indicator that best suits the current market environment. Is one indicator or another more useful in trending markets or in range-bound markets? How should a trader view the indicator and oscillator selection process? For example, banded oscillators, such as the volume oscillator described at the end of Chapter 10, which fluctuate between upper and lower bands, are widely believed to be best suited for range-bound markets, as they show overbought and oversold situations. To use oscillators for this purpose alone, however, takes away from another valuable use of oscillators, their ability to show the strength and sustainability of an existing trend. In general, assigning different indicators to different market conditions presents a host of issues regarding trading analysis, including timely identification of range-bound versus trending markets and frequent changes in strategies. In our experience, simple is better. One option we highly recommend is to use a trending or longer-term volume indicator with a short to intermediate-term indicator or oscillator that covers most market conditions. In Part 2, where specific indicators and oscillators are discussed, we do suggest combinations of indicators and oscillators that make sense in specific trading environments. But for the most part, we prefer designing a strategy that works across trading environments. Still, it is important to learn the characteristics of your preferred indicators and how they actually behave under different market conditions. Once you get comfortable with your chosen indicators and the signals they send, you will know at a glance what type of market trend is prevalent. For example, if a longer-term trending indicator such as on-balance volume, see Chapter 9, is moving higher highs and higher lows, you know that the market or security is in a recognizable uptrend. The same reading can also be made by looking at an oscillator, because in uptrends, oscillators tend to top and bottom at different levels. That is, to move in a different range from what they do in downtrends. It is also important to know where support and resistance levels are and to watch how price, volume, and your indicators behave as these support and resistance areas are encountered. Doing so can keep you one step ahead of the crowd in knowing whether a trend will continue or whether a trading range or reversal is forming. As an example of how oscillators perform differently in uptrends versus downtrends, note in Chart 7.4 how the Money Flow Index, MFI, further described in Chapter 10, tends to top and bottom at lower levels in a downtrend versus higher levels in an uptrend. Since the MFI is a banded oscillator, it uses the level of 80 for overbought and 20 for oversold. Blindly using and accepting only these levels can cause a trader to miss out on some great trading opportunities, as the MFI, when used with its common default setting of 14 periods, rarely reaches 80 overbought in downtrends and likewise rarely reaches 20 oversold in uptrends. It is important to plot the indicator and note its characteristics on any market or security you trade so that you can know where to expect range shifts and turning points based on the trend. Indicators versus volume and VMA. While volume is a tremendous tool for measuring trader sentiment, it is only one dimension of the analysis process, much like using price action alone. For this reason, in our volume analysis, we never lose sight of the fact that volume and price movement are inextricably linked. The key is to look at both volume and price together, or to use indicators that combine volume and price components. Volume and the volume moving average, VMA, see Chapter 3, are great for spotting trends and turning points in sentiment. They fall short, however, as they are unable to identify the direction of the price trend or the proper price points at which trades should be entered and exited. Longer-term trending indicators, such as on-balance volume, Chapter 9, in contrast, use the daily change in closing price to determine whether the volume for the day has been positive or negative. Short-term to mid-term oscillators, such as the Money Flow Index, use price data before volume data are applied to their calculation. Both of these indicators have the ability to give a sense of both direction and strength of price movement, which are the most critical components of trend determination. Volume measures the strength or conviction behind the identified price trend, giving a trader clues to whether the trend is likely to continue or deteriorate. Essentially, it is our view that both types of volume analysis are complementary and serve to confirm each other. Position traders, when to exit and stand aside. When trading the market and using indicators, it is always wise to heed the warning signals given by your preferred indicators. Position traders, who are less interested in catching turning points than they are in riding trends and protecting profits, should consider using multiple volume indicator combinations to signal when there is real trouble ahead. The example of the Nasdaq 100 Trust ETF QQQQ in chart 7.5 uses the combination of volume price trend VPT and the MFI and volume with a 9-period VMA. The example given by the steady uptrend followed by the volatile reversal in the first half of 2010, punctuated by the flash crash, is telling. Notice in the move higher off the March 2009 low through January 2010 that VPT continues to make higher highs as price pushes higher. Even though these increments were marginal, they were higher just the same, thus validating the rally. Now take a look at MFI just below VPT in chart 7.5. This is an example of knowing the characteristics of your selected indicators. MFI bottomed at the 37 to 40 level throughout the uptrend. Each time MFI moved down to that level, a momentum bottom was formed as MFI reversed higher, giving an indication that prices were ready to resume their uptrend. The first sign of trouble for the uptrend was in January 2010, as MFI made the lowest low along the way, clearly breaking down through the 40 level, all the way down to 27. This was a sign that, during this pullback, sellers were applying more pressure than in any other previous pullback during the rally. That didn't signal that the uptrend was over, it merely showed that the uptrend was losing its strength. The uptrend resumed following the pullback as price pushed out to new highs in March, grinding higher into May. As price continued higher, note how MFI made its final high on March 18 and began to decline as price continued higher. That shows an obvious loss of momentum, but what about the major trend? What is VPT showing? Notice how VPT never eclipsed its January high, even as price moved considerably higher into May. That was a major sign that the uptrend was laboring. Finally, take a look at the VMA in the very bottom frame of chart 7.5. Note how it never increased during the final push higher into May. Other rallies lacked impressive volume to that point, but there were at least periodic surges in volume that managed to push the VMA higher. There were no such surges in the March-May 2010 period, showing that buying pressure was waning. Now let's zoom in on the final rally from the February 2010 low to the May 2010 high to see where risk or equity exposure could have been reduced. See chart 7.6. Of course, as with any trading strategy, you need to have a plan for how much risk you are willing to take off the table and when, but the combination of indicators in this situation would have given ample warning to allow for the execution of such a plan. Chart 7.6 shows how a trend line was drawn off the February 2010 low. Even though VPT and MFI are showing signs of trouble, there is still a definite uptrend in prices supporting the plot of a trend line. When that trend line is violated, it is time to move to cash and stand aside. Prior to the trend line being violated, however, the new high made in March is not validated by either VPT or MFI. That signaled that equity exposure should be reduced. That wasn't necessarily a signal to exit and stand aside because divergences can last for weeks, as was the case here. Selling into rallies was the best plan, as price continued to grind higher with an obvious loss of momentum. One final piece of the warning puzzle, volume finally began to pick up in late April 2010, as price chopped sideways. Again, this was another change in the characteristics of the rally. Volume had been uninspiring to that point, and when it increased with difficult upward price movement, that was a sign that sellers were putting solid overhead supply on the market. On April 27, the uptrend line off the February low was violated, which gave plenty of time to move to cash before the May 6 flash crash occurred. Indicator and oscillator sensitivity. When incorporating indicators into your volume analysis, it is important to select the proper trading time frame parameters. For example, when using MFI on a daily chart, the most commonly used setting is 14 days, as used in the previous examples. A time frame of 5 days gives more overbought-oversold readings, while a time frame of 21 days gives fewer but perhaps stronger overbought-oversold readings. The long-term example from August 2008 of the Nasdaq 100 Trust ETF QQQQ in chart 7.7 shows the number of overbought-oversold reading generated with the 5-day versus the 21-day setting. Notice on the 5-day setting how MFI reached the overbought-oversold levels many times throughout the 22 months shown. Settings this sensitive give many false signals, so care must be taken to find the right balance between quantity and quality of signals. As for the 21-day setting, see chart 7.8. Note how it never quite reached the oversold level in the 22 months shown, while it reached the overbought level only once, in March 2010. When it did reach that level, however, the signal was strong and important given what followed. These are simple examples of how the time frame settings can affect the performance and frequency of signals in an indicator or oscillator. Chart 7.9 displays a 30-minute view of the US dollar index continuous contract with the combination of VPT and MFI. Even though the 30-minute time frame is considered very short by less active traders, a true sense of trend can be determined by both price action and VPT. As VPT makes a series of lower highs and lower lows, it shows real intraday weakness in the US dollar index. That means that since the trend is down, MFI can be used as a trade filter to identify potentially profitable short positions as it rises to overbought levels above 80 and crosses back below 80. However, the trade should not be executed without a trigger such as a move that takes out a prior low. One reason for this is that the MFI reflects momentum and requires some other form of confirmation to determine that the downtrend is indeed resuming. Note how the downtrend from June 9 through June 17, 2010, yielded some great intraday shorting opportunities. The next example shows how combining indicators at the opposite end of the time spectrum can also be effective. Chart 7.10 is a weekly frame of the SPDR Gold shares ETF GLD. The indicators paired in this example are accumulation distribution and ease of movement. Accumulation distribution is a cumulative trending indicator, while ease of movement is a centered oscillator, meaning that it generates signals when it crosses above or below its center line, which has a value of 0. The ease of movement indicator tends to bottom very close to the 0 line in uptrends, and top very close to the 0 line in downtrends. In this example, we are only interested in those crossovers that push decisively above or below the 0 line. Note in chart 7.10 how accumulation distribution shows a solid uptrend since the 2004 low, with the exception of one corrective period in the second half of 2008. By pairing accumulation distribution with ease of movement, an effective trend following strategy can be developed. Blindly buying and holding during this period would have ultimately worked out for the buyer, but no doubt he or she would have developed stomach ulcers along the way. Using a volume analysis strategy combining these indicators would have helped a gold trader sleep better at night, especially during the 2008 meltdown when GLD lost over 30%. The GLD example in chart 7.10 has the 0 line marked in ease of movement. Crossovers of this line provide signals to either take long positions or move to cash. This strategy doesn't catch every ounce of upside, but it allows a trader to catch the meat of each trend while sitting out the sharp sell-offs. Up until now, we have looked at some of the more conventional volume indicator pairings. In this final example, we will add another layer to take the guesswork out of the timing of our entry. The US dollar index example in chart 7.11 shows how a combination of indicators in a 5-minute time frame can yield great results. The plot follows the MFI and VIT on June 20, 2010. First, note that the VIT is making higher lows while the MFI is bottoming at around the 40 level even as price has pulled back. Both are bullish characteristics. With a setup like this, it is time to look for a long trade entry. The question is, what will be the trigger to execute the trade? A conservative solution would be to wait for the previous resistance level to be taken out. A more aggressive solution would be to simply buy here with a price stop, just below the previous lows. Since the first option would leave precious profits on the table, and the second would be more of an exercise in blind faith, let's add one more piece to our analysis: the Leibovit volume reversal. Notice in chart 7.1.1 how the positive VR between 10 a.m. and 11 a.m. signaled that buyers were taking control of the market. In this case, the positive VR is backed up by the positive setups in both VPT and MFI, and it led to a very successful trade. Summary: volume analysis requires understanding volume technical indicators and oscillators, and how they perform and apply to the market conditions and securities being traded. To a large degree, finding the right indicators among multiple combinations of indicators takes practice and experience. There is no one-size-fits-all solution. One of the more challenging tasks in an analysis is designing combinations of indicators to support a trading time frame. It isn't just about selecting the indicators. It's also about selecting complementary time frames and setting trading parameters.
Thank you for listening to this audiobook. We truly appreciate your time and support. If you enjoyed the content, don't forget to subscribe to the channel, like this video, and share it with others who may also benefit from it. Your support helps us bring more great audiobooks and learning resources to you.